homework after, but for some reason you want to give it to me now, so you can just throw it on the table. It's fine. Probably save the time. Somebody, another professor. Thank you. Let me see if she's up.
Sorry, I turned it off because I didn't want it.
That's okay.
Gets in line.
All right, let me get them out. Okay. What happened here? That's odd.
We'll get started in just a minute. Right now, please. We're getting started in just a minute, but we have Lena who's going to speak to our co-authors. We do a little research, and we're going to ask you if you're willing to participate. She'll explain it to you. The good thing, the upside, is that you'll be able to keep your laptop, cell phones, iPads open during this session, which will be Tuesday.
Hi, good morning, everyone. So my name is Dr. Leanne Sanchez. I'm a professor at the Urban Education Department on Bradley Hall. Thank you for, I'm working with Dr. Sannella to collect some data in various business school classes, and also we will be going into the arts and sciences classes, primarily the sciences. Does everybody have a handout? It should be coming up now. If there's any extras, you can leave them in the back. Okay, so if you can take a moment and read through this. So this is an actual consent form. I know that it says undergrads and your graduate students, so I apologize for that, but it still serves the same purpose. Now, the project is to collect some information regarding how engaged and motivated you are during class time. So as Dr. Sannella mentioned, on Tuesday, do you have questions? Comments? So on Tuesday, we will be giving, you'll be allowed to have your laptops or your cell phones out. And at predetermined times, you will get an email from me with a short survey. It's 10 questions. It should take you about 5 minutes to fill out. Regular questions is asking how, are you paying attention? Are you distracted? Right, exactly.
Trapped, but
I won't know who you are, so if you, just be honest. I mean, if you're asleep, just say, I just woke up, or,
Right. So even though,
Sannella be tracked.
No, I don't know you.
right,
That's why.
right, exactly. It's confidential. So the only person that will actually be seeing your names will be me.
What about,
Yeah.
what about the totality of the data?
Right. So that's what I'll be showing.
Professor Sannella.
Right. We'll see.
Yeah.
Exactly. So
I'll just have, send me like a survey, the anonymous surveys, except when people put their names on them,
So you'll see, okay, at 10:30, nobody was paying attention. So what's going on in the lesson that, forced everybody to not pay attention? Is it the cell phones that are distracting you? Are the computers distracting you? So those are the types of things that we want to find out, so that we can make adjustments in our instruction to kind of meet the needs of the students. Okay? So you should take a minute and read through this. If you would like to participate, I ask you to please sign the back and the front. Yes,
Is this only occurring next Tuesday?
this
Yeah.
will only be
Yeah,
occurring
no,
next
if
Tuesday.
you're not here for the holiday, you can't.
Right.
It's not your money.
And only if you sign it, get your laptop open. If you don't sign it, you can't have it.
Right, so I'll be here monitoring where you're sitting, because we'll send you a survey this afternoon, asking you for, do you have questions? Asking you for an email that you usually check during class, even though we said that we don't, but at some point during a break. And it'll ask you also just some general questions on where your feelings are toward, the major and the minor. So take a moment, kind of read through it. If you have any other questions, I'm here. I'll be standing in the back. And I'll just be coming down through the doors, through the aisles to pick up the consent forms. If you don't want to sign them, this is completely voluntary. Your grade is not affected at all. So please make sure that you keep that in mind. It's completely voluntary. Of course, it would be great if everybody participated, just to get a feel for how to stand, their emotions and your motivation and engagement.
That's blank. It's not blank. Do you have any more blanks?
Yes.
Any more blank forms around? Great. All right, so we need this. Okay. All right. All right, so if you decide to participate, when you fill out the forms, Lena will be in the back, just pass them back, and we'll take it from there. And we'll see how it goes on Tuesday, okay? All right. Now, let's get back to today. Let me explain what's happening today. Hello? Today, of course, we're going to be in this room for a double session. We wanted to accommodate your operations midterm. Next week, we'll be accommodating Professor Oppenheim will be out for the holiday on Tuesday, so we have the same setup on Tuesday. And today we're going to just say a few words about disclosures on earnings per share, and then we're going to move into Chapter 17. Chapter 17 will deal with accounting for investments. This will get us involved in the so-called mark-to-market accounting. This will also be a sort of a prelude to mergers and acquisitions when we cover the equity method. Again, hold on to your assignments. I'll pick those up on the way out. And if you have the module, we're doing 16.4. This is should be on your page 4, I believe. Yeah, on the bottom of page 4, going into page 5. I just want to go through a couple of disclosures, and then we're going to move right into Chapter 17. So this first disclosure, and incidentally, these are all hypothetical companies. I essentially modified published financial statements. So on the bottom of page 4, we have a partial income statement, and just one of the things I wanted to show you, that if you look at the way the income statement is structured, you're going to find that obviously it starts with sales, but I've got it beginning with discontinued operations. Notice that this is a single statement approach for reporting comprehensive income, a single statement approach for reporting comprehensive income. So if you look at the highlight where I have other comprehensive income, right below net income, you're going to find the comprehensive income. Then below that, we have the earnings per share disclosure. And as we indicated during the lectures, earnings per share is simply a disclosure. Yep. What's that? It works. Okay, I guess I can... yeah. Okay, so can we do this? Be more than happy to do that. Can everyone see this now? Because I definitely use the board. Oh, I'll bring that down. Yep. Okay. Okay. I don't know. Well, let's see what it looks like when it comes in. Okay. Oh well. Move this over. Okay. Okay. All right. So again, this again is the single statement approach to showing the comprehensive income. So you append comprehensive income directly to the income statement. Then you have your earnings per share disclosure. Earnings per share, of course, is going to be on continuing operations, on the discontinued operation, and on net income. As we explained during class, the discontinued operations disclosure for earnings per share is optional, but almost everybody will show that. Now, when you look at the rest of the footnote, you're going to see information that we described in class. So it talks a little bit about how earnings per share is calculated. Notice that there are two classes of common stock. Again, just for reference purposes, they've got regular common and Class A common. They add those together. Class A common could be a new class of stock. What could be happening is that they're buying up their common stock and issuing Class A or swapping Class A shares for the regular common. The Class A shares may have different voting rights, or they may have no preemptive rights. So that's what a lot of firms are doing. They're trying to eliminate shares that have preemptive rights and replace them with those that don't. Notice also they talk about the dilutive effects of stock options. They tell you that the stock options they have, but notice at the end here, let me just see if I can highlight this for you. It talks about that options were not included because they are not in the money. So out of the money options or anti-dilutive securities have to be reported in that footnote, which we mentioned during class. Yep.
There was like a poison pill or some kind of fraud that would cause like mass deficit. Would that be disclosed?
Yeah, in the preferred, that would be, for example, on a preferred stock. For instance, you have several different clauses in preferred stock that would have to be disclosed. So if you remember back in Chapter 15, the objective of accounting for stockholders' equity is to provide all information that different classes of stock and anything that could affect the rights of the common stockholder. So a poison pill preferred, which becomes voting upon certain conditions, which could be a merger, a potential takeover, or it could be if the preferreds are cumulative and the dividends go into arrears and they automatically become voting, that would have to be disclosed there as well. But in the earnings per share disclosure, the key is the fact that from the analyst perspective, the analyst needs to know that there are other potentially dilutive securities that may not be included in this calculation because their effects are anti-dilutive. All right, now, the other second company that you see here, same idea. I'm giving you partial income information, and you do see, of course, the earnings per share on different categories of earnings. But what I wanted you to notice here is that in the footnote, it's going to mimic our calculation for earnings per share. So in other words, you notice that they start with net income, $260,334. To that, they subtract out the preferred dividends, and of course, they have net income available to common. So the actual calculation, the way I mentioned it in class, you don't have to show this in a sort of an equation or a fraction. You could show it in a table. So this is a very common type of disclosure. So you've got net income minus the preferred dividend requirements, and then that's divided by the weighted average number of common shares, and we're showing the reader how we got basic. Then when you go to diluted earnings per share, notice that they add back. So I know that when I do this, I basically say, I try to come up with an equation which is, incremental. So I'm going to say that for basic, and hopefully you could see this. So in this example, just taking the numbers, it would have been 260, 334, 4158, which are the preferred dividends, 114,075 becomes your weighted average number of shares. Then when you move into diluted, if this is DEPS, we add back the preferred dividends. Okay, we'll get this up in a second. So when you're looking at that footnote, you should have it in front of you. You'll notice that you've got the diluted section that starts with the 260, 334. So they're essentially adding back preferred dividends. Now, there is a slight effect here, and that's one of the unusual numerator effects that we have, and that's called an increase in expense if preferred stock is converted to common. So this is an additional expense that we add. And then, of course, the weighted average number of shares. When you look at the preferred stock, if the preferred converts to common, that's going to add 2561. And then there's also options. When they convert, there's no income effect, and the number of shares here should be 582. So I'll try to make this large enough. I know it's tough without the screen. We've got 117,218 as your number of shares for diluted EPS. All right, so when you calculate diluted EPS, this would be the preferred, the convertible preferred, and these are the options. And I'm sorry, this is on an angle. I'll move it like this for now so you can see it perhaps on that side too. Okay. In certain types of contracts, when there are convertible preferreds, if they go into an employee stock option plan, you may start expensing some of those preferred dividends. So there may be an expense charged against income. So that would be an example of a dividend that could be written off on the income statement. So in this case, it could be an additional expense in processing or whatever the process or the logistics take to convert. So that's a cost of conversion that gets subtracted. Okay. All right, so the cost of conversion, let me move this over so you can see this a little bit more. Yes. Okay. Sorry about that. So what happens here, we take the income after we add back the preferred dividends. So you got 260 when we're starting to calculate diluted. You've got 260, 334. Then you notice from the screen, we're going to subtract out the expenses or add back the, subtract the expense rather. And then the shares are going to be increased from the conversion of the preferred and then the stock options. So the footnote to the financial statements is exactly the same way that we presented it in class. And again, if on an exam or any kind of problem solving, if you don't want to use a ratio, feel free, of course, to use the table like this. Certainly going to be correct. Okay. All right. Now, one last disclosure, unless you have any other questions. We talked about the net loss per share. And then let me now show you what a net loss per share disclosure looks like. One of the things that, I'll give you a couple of examples. The first company, this Tarmax, again, are hypothetical companies. Notice that when you have a net loss per share, it has both basic and diluted earnings per share at the same amount. Why is that the case? If there's a net loss, why are they the same? Yep.
Because any additional thing in the denominator would automatically make it into the.
Yeah, so right. So any assumption of conversion would make this anti-dilutive at the continuing operations level. And you notice they don't have any unusual items, so everything is continuing operations here. So they would only show basic and diluted loss per share, and then of course they describe that they used the treasury stock method if in fact that was the case. The next very important disclosure for me to make sure you understand that preferred dividends increase the net loss. So what I want you to notice is that if you're looking at 2014, the net loss $16,869,315, that net loss is increased by the preferred dividends. So the preferred dividends increase the net loss to $24,136,646. So once again, the net loss is increased by the preferred dividend requirements. And once again, the basic and the diluted EPS is going to be 43 cents per share. Once again, you would not include potentially dilutive securities because that would obviously lower the loss and that would make it anti-dilutive. That would increase the earnings per share. All right, so those are the disclosures. So once again, two takeaways from the disclosures. The footnote will be exactly the way I would like. You don't have to do it in an equation like this. If you want to show EPS in a table or in a schedule, that's absolutely fine. You could show it in a ratio format as well. The disclosures in publicly distributed or publicly issued financial statements will have the tables, so you'd be very consistent with the disclosures. The disclosures also, second takeaway is that the disclosures will always indicate that securities are excluded if their effect was anti-dilutive. So we'd have to tell you what other potentially dilutive securities the company has. And then finally, here for the net loss, typically you're going to have basic and diluted will be the same, unless of course there is net income at the continuing operations level. Just to review, we test for anti-dilution at the continuing operations level. And then, of course, the other important point is that preferred dividends will increase the net loss. So any problem, any client, wherever you are, where you encounter earnings per share, in the case where there's a loss, preferred dividends will increase that net loss. Okay. Now, that is it for EPS. Are there any other questions, comments on the EPS calculation? Yeah. Yeah, and that's all they have in this case. So they didn't have any, I don't think they had any, let me just double check this company. Bain Company did not. Let me just go back and look. Yeah, it's going to be, that's going to be a full, sorry. Yeah, that's, they only had, they had no extraordinary items and no discontinued operations. If they had extraordinary items and discontinued operations, and if there was income at the continuing operations level, then the potentially dilutive securities can be included in the calculation. Okay. All right. Any other questions? Any other comments? Okay. All right. So what I'm going to do now is I'm going to get into. We're going to start Chapter 17, and from the semester perspective, the three remaining topics are probably the, hot items in accounting. Mark-to-market accounting or fair value accounting in Chapter 17. Chapter 18, we're going to look at revenue recognition the way it is now. By the way, every one of these chapters is going to have a big sort of guess, what if or hypothetical, because right now we do have a standard that is in the works for investments. So Chapter 17, although it'll be similar, might change. Chapter 18, revenue recognition, that's the one that is probably going to be turned upside down. I know, Anna, you saw, and I'll try to get that article. Anna sent me an article on some of the changes. I have a few others that I may have even posted it already on Blackboard. So we might have a complete revision of revenue recognition. And then, of course, income taxes and pensions. So those are the key chapters that are coming up. All right, so let's get started. I'm going to move this down and get this out of the way, and let's talk about investments. When we look at investments, the key here is going to be I'm going to get this out of your way, what we consider to be what we call mark-to-market accounting, or this fair value accounting. And mark-to-market accounting actually started quite a while ago, but the key points here is, first we'll talk about accounting for marketable securities. When we do account for equity and debt securities, we have what is known as a multiple attributes or a multiple measurement model, where it gets a little bit more confusing than it really should because of the different ways we measure different types of securities. And I'm going to tell you that the exposure draft started off being much more simplistic, but as always, when people start getting their hands in there and their own politics start getting in, you wind up with a more convoluted statement. So I'm going to tell you the new statement is not that much better in terms of simplicity, but it may be a bit more transparent and it may be a bit more theoretically justifiable than what we have now. There's a self-study problem that I'd like you to look at. It's a multi-security portfolio, and then we'll look at some sample disclosures. Now, we know we're in trouble right away when you look at this. You've got three standards in effect right now to account for the same thing. So it means that pieces of each standard are still in effect, other pieces have been superseded. 320 ASC, of course, is the accounting standards codification. That has been around for a while. The fair value measurements, we'll talk about that in Module 2. I also have a flow chart I posted on Blackboard, and I'm sorry if I forgot to tell you to bring that, but you can always print that out. And then there's this fair value option, which is interesting because that's the option that allows companies to measure certain and eligible, there's lots of eligible securities and a lot of eligible debt instruments that could be measured at fair value, which means that, and this happened with General Motors during or one of the firms, I believe it was General Motors, during the recession. If you mark a debt instrument to market and debt is declining, what's the entry to write this debt down on your books? It's a liability. How do you reduce the liability? Got a debit, right? You're going to debit the liability. What do you credit? What do you think? It's a gain. Yeah, it's a gain. So if you had, this is where the Wall Street Journal and other parts of the financial press had their heads exploding. Hey, you got a company that's bankrupt, their debt is becoming worthless, they write it down on their books because they adopt mark to market or they adopt the fair value option, you debit the liability and credit the gain. So your income goes up as your debt becomes worthless. So that was one of the downsides of this option that you have. Now, of course, today it's not going to be that dramatic and it's not as highly criticized as it once was. Now, let's take each standard separately. And the first one is 320, and this is the sort of the kickoff of mark-to-market accounting in the United States for industrial companies. What you need to remember is that mark-to-market accounting had always been used for insurance companies and other financial service companies. And this standard permits the securities to be marked to market, marked into fair value. And the question, of course, is where does the gain or loss wind up? It does not apply to the equity method, which we'll talk about in a minute, and it also doesn't apply to not-for-profit. But under the standard, and by the way, all debt securities and all equity securities under the standard will be marked to market unless, of course, depending on the portfolio, unless, of course, fair values are not readily determinable. In that case, we would maintain them at cost. It's not, today, It's probably not all that difficult to measure fair value, as we'll see. We could estimate fair value, but for the most part, if you determine that fair values are not reliable, then you could still carry the investments at cost. Now here's this multiple attributes or multiple measurements model, and the proposed exposure draft is really no different. It has multiple measurement, multiple attributes, and they just change the terminology a little bit. We have three portfolios. You have a held to maturity, a trading, and available for sale. And I thought what we need to do first is summarize this and then get into an example. So let me start with the first, on the second page, if you go to the table, let's get into the first portfolio. And the interesting thing, of course, is that these portfolio classifications are based on management's intention. The new standard is not that much different. It's going to be based on the company's business model. So where do you get the business model from? I guess you have to talk to managers, but it's going to be pretty similar. But the first category is held to maturity. Held to maturity is typically going to be a non-current asset unless, of course, you can convince the accountants that the securities are being held for current working capital needs and they're going to be sold shortly. The held to maturity classification will only include debt securities. So that's important because you cannot have, obviously, an equity security there. And I would imagine that if you look at a redeemable preferred stock, that's going to be considered debt and could go into this category as well. Now, how do you know if the security is properly classified? Management has to prove that they have the intention and the ability to hold the security until maturity. And if that's the case, and by the way, you just can't say, I think I'm going to hold it for a long time. You have to show them that you don't have immediate cash needs. And obviously, if something happens that was unanticipated and you sell the security, it doesn't mean that the original classification was fraudulent. It just means that circumstances and economic conditions changed. But when you notice here, it is not measured at fair value. So the first or second most important thing on the held to maturity is that this is at amortized cost. It means cost plus the unamortized premium, original cost minus the unamortized discount. So it is not subject to mark to market. It's not subject to fair value accounting. On the income statement, interest is recognized as it's earned. You amortize a discount or a premium. And the realized gain, and here's a big difference. We got to stay wide awake here and maybe too early in the morning for this one, but we've got the difference now between the terminology realized and unrealized. The realized gain is when the item is sold, when the financial instrument is sold. That's going to flow through net income. So the only income effects you have on a held to maturity portfolio are going to be the interest recognition, whether it's on a discount amortization, whether it's cash interest, and then of course you have the realized gain on sale. All right, so that's the first category. Any questions on the held to maturity? Now again, debt securities could be in any one of these three, but in order to be in the held to maturity category, it has to be proven, or at least management has to convey their intention to hold and their ability to hold it until maturity. And once again, during the bailout period of the recession, lots of companies were able to avoid writing down toxic assets because of a rule that we'll talk about later. Holding it to maturity means that they're going to be able to recover losses. So companies holding toxic mortgages were able to avoid huge write-downs because by holding them, you assume the market will recover at some point and the losses would be recovered. But we'll get to that. Yep.
And you said redeemable preferred shares are in this category?
Redeemable, yeah, if you classify them as debt. And then your obviously maturity date would be the date of the redemption. Haven't seen much of that, but it would probably fall into that category. You can make a case for that. All right, next is the trading portfolio. And this one is always going to be current, and of course, debt and equity securities will be included. On the trading portfolio, the idea is that you're acquiring the securities to sell them very quickly to take advantage of favorable price movement. So you're trying to hold them quick and trade them quickly for an immediate profit. Typically, this is done, and by the way, no specific time period is specified as being short-term or short period of time. So management doesn't have to tell you we're going to sell it in 3 days or we're going to sell it in 15 days. Back when I was auditing, we used a short-term, long-term classification where management would indicate if they were going to hold the security for a long-term or a short-term. And sometimes they tell us this is a short-term security and I'm on the client for 4 years and they're still holding the same portfolio. So it really depends on whether or not they're going to trade it at a profit. Now, when you look at the company's organization structure, it's either going to be a company that is going to have a treasury department or a treasury department function that trades these securities on a regular basis, or it's going to be a financial service company where you would find a trading portfolio. Trading portfolios are not all that common in industrial companies unless they have a treasury department that trades securities for a short-term gain. So it has to be part of your normal operations. Now, when we look at the income statement, there are a couple of things to notice. First of all, let me highlight these. The first thing is on the income statement, even more importantly, on the balance sheet. On the balance sheet. These are accounted for at fair value. They're accounted for at fair value. Every year, at the end of the accounting period, you go to the market, you get the closing market price. Did anyone work on fair values during internships at all? Yeah. So you get the closing market prices, and you would value them at fair value. The difference, let me see if I can, I'll move this out if you can't see it, just for this purpose. So that on the balance sheet, you're going to see the security itself, and that's going to be trading. And that's going to be the cost, the original cost to be here. We're going to use an allowance account. And the valuation allowance on the balance sheet So let me move this. All right, so on the balance sheet, we're going to be using an account, which is the valuation allowance, fair value, valuation allowance, doesn't really matter what it's called. If you debit this account, it's a gain or a write-up. The question is, where does the credit go? And we'll talk about that. And on this side, if you credit the account, it's a loss or a write-down. Now, there's no normal balance here. I mean, if it has a debit balance, you're writing the security up. If it has a credit balance, you're writing the security down. Now, the bigger issue, of course, to me, is when we make our adjustments. If you remember back in Intermediate 1, I tried to emphasize when we used, and again, these concepts keep coming back. So if you remember the notion of a balance sheet approach versus an income statement approach when we use allowance accounts. When we use an income statement approach, we just worry about the debit or credit to the income statement, the gain or loss. On bad debts, we're worried about the expense. What do you debit? Credit the allowance, we don't care what happens. Here, we don't use an income statement approach, we use a balance sheet approach. And what does a balance sheet approach tell you? You have to determine the balance you need in this account. And the adjustment is forced by the amount of the balance that is required. This is going to use a balance sheet approach to determine the allowance account. And we will illustrate that. I'll illustrate a 2-period adjustment where it has to be done on an income, on a balance sheet approach. Now, the question is, what happens to the gain or loss on the write-up? and we'll get to that in a second. But any questions on the allowance? So the allowance account is going to be used in this case, and I know, look, I mean, I'm not as big on all these little points to, needle you with, but this one we have to use an allowance account. So we've got to use an allowance account here. You would not write the security down directly unless it was impaired. We'll talk about impairments. So you don't write it down or write it up directly. You do it through an allowance account. Very similar to accounts receivable. You don't, we don't use a direct write-off approach, so to speak, here as well. The net amount is shown on the balance sheet. I mean, you typically don't see the two accounts on the balance sheet. All right, so any questions on that? Yes? It's not, no, because if it has a debit balance, it's an adjunct account. So when it has a debit balance, oops, it would be like an adjunct account, and if it has a credit balance, it would be a contra account. Could be either. Depends on the balance. If you're writing it up, it's an adjunct. If you're writing it down, it's a contra. So we just call it a valuation allowance. We don't think of it as a contra. We don't think of it as an adjunct because it can be going in either direction. Okay. Any other questions? All right. Now, income statement. Do you want me to move that? I'm sorry about that. Let me just, okay. If you look at the highlighted area in yellow, let me move this over again. Okay. What goes on the income statement if we have a trading portfolio? Well, interest and dividends as earned. And here's an interesting point. Regarding premium and discount amortization, yeah, I guess it could be done, but typically you don't amortize the premium and discount because of the theoretically short-term nature of the holding. So if you buy the security today, you'll sell it by Monday, and therefore the premium or discount amortization would be immaterial. So yeah, you could amortize the premium and discount. Typically, you don't see that for a trading portfolio. Now, once again, the notion of realized versus unrealized. Realized gains and losses on sale go on the income statement, and then here's the key. The unrealized gain or loss on the mark-to-market adjustment goes into the income statement. So for the trading portfolio, when I debit the allowance account, I credit the income statement. So when you write up the trading portfolio, the trading portfolio is going to be debit to the allowance, credit to net income, or credit to earnings. So this flows right through the income statement. Now, the new terminology, if you just search for, the exposure draft or the new draft, they're calling something like this, and maybe this is a good way to remember the trading portfolio. Although they don't call it trading now, they have a whole different paradigm, but the results are very similar. On a trading portfolio, it's fair value into net income. So they're using the acronym, FVNI now as the way to look at these securities. Trading fair value goes into net income. Now, why does this go into net income? Unrealized gain. What do we say about putting it into comprehensive income? Well, in this case, everything points toward an income recognition because, number one, short-term holding means that you expect cash flow very quickly. So putting it in the income statement isn't going to be a problem. You have high probability of short-term cash realization. And it is part of your normal operations. As I said, the trading portfolio has to be associated with a treasury function or a financial service entity where this is performed on a regular basis. So that it's not going to be the case where you would have, unusual volatility by holding this for several years. It could happen, but that's not the intent. All right, that's your trading portfolio. Any questions on trading or any other questions on trading? So that's going to be a fair value into net income category. And finally, you have the last category. I'll move this up as high as I can so you can see that, is available for sale. Available for sale is sort of the default category. It's neither trading nor is it held to maturity. It is a non-current portfolio, unless, of course, you could prove that you're holding it as working capital. It includes debt and equity securities, and essentially it's just the default. It's not trading. It's not held to maturity. Now, once again, this is going to be mark to market. So this is a fair value. See in the yellow highlighting, it's a fair value using the allowance accounts. It's the same story we have here. You debit the allowance for a gain. You credit the allowance for a loss. The question is, where do you report the gain or loss? And the answer in this case is that this goes into accumulated other comprehensive income. This does not appear on the income statement. And the reasons go back to chapter 15 or wherever we looked at comprehensive income. What do we say? Low probability of short-term cash realization, not part of your normal operation, and if you put it on the income statement and hold it for a long time, you're going to get volatility in income. Same reasons, does not go into the computation of earnings. The new standard is going to say, although they don't call it available for sale anymore, the new standard is going to call this FVOCI. So available for sale, although they won't call it available for sale, they have a new terminology that they're going to use, but it's going to be fair value into comprehensive income. Does not go on the income statement.
So the biggest difference between available for sale and trading is that available for sale are basically investments that are not held to maturity by a business that does not have a treasury department.
Yeah, not trading on a regular basis.
Not financial.
Exactly right. Yeah, not a financial institution. You don't expect these to be traded. At the same time, management hasn't given you any proof that they're going to hold it to maturity. They give you no indication that they intend to hold it to maturity, no indication that they have the ability to do so. So it's the default category, and therefore the gains and losses sit in comprehensive income. Now, of course, interest and dividends are recognized as earned. You would amortize the premium and discount, and once again, realized gains. And again, over here, don't forget, let me make sure we get this terminology straight. These are your unrealized and realized gains on sale. Unrealized go into stockholders' equity. The realized gains and losses, of course, are going to go on to the income statement. So if you sell it, it goes into the income statement. All right. So those are basically, and I thought we'd do this rather than just read through, slides or notes. Just look at the table, and that really pulls it all together up front. Of course, I have to illustrate some of this as we move along. However, one of the things that generally comes up, and if you thought about this long enough, one of the things that comes up is saying, all right, let's, and as I said at the beginning of Intermediate 1, we're not saying that everyone that works in corporations is thinking to manipulate earnings, but from a person that has to look at things with professional skepticism, I would say, well, gee, I got a good idea. If I'm taking a huge beating on some of my securities, why don't I just move them into available for sale? This way, I don't have to take the hit on net income. Right? Well, the FASB thought of that. So here's what happens. Let's go to the next table here. And what about transfers? Transfers between portfolios, because obviously FASB thought that was going to happen. In fact, I don't remember if people were moving things around, and then they said, oh, we better do something, and they added a amendment. But here's what happens. Anytime, first of all, I'm going to tell you that any transfer at any point is done at fair value. All transfers are done at fair value. I don't care where it's coming from. As soon as you move it, you fair value it. Now, the first two are transfers to or from trading. The first line is a transfer to the trading portfolio. So what happens? On the day that you make the transfer, you mark the security to market. The gain or loss, if you look at the last column, goes into net income, and of course, what I don't like about, and I can't modify this, but it's the best one I could find, I guess. I should probably do my own. But if you look at the last column, when you transfer into trading from the available for sale portfolio, you create the gain and loss, or you measure it now at fair value. The gain or loss goes into net income, your last column. How does it affect stockholders' equity? It gets close to retained earnings. That's what they're saying in the third column. If you transfer it from available for sale to trading, it's the same thing. You mark it to market, you take the gain or loss on the income statement, the last column, and it affects stockholders' equity by closing it into retained earnings. So very simply, any transaction that transfers, or any transfer to or from the trading portfolio, is marked to market, income statement is hit with a loss or augmented with a gain, and of course stockholders' equity goes up or down with the transfer to retained earnings. So that's any transfer involving the trading portfolio. Okay. Questions on the trading portfolio. So anything you move into or out of the trading portfolio is going to, of course, they all are transferred at fair value, but it will immediately impact your earnings on the date of the transfer, immediately. So if you're thinking that you could take a trading security and change the designation, moving it, so here's the game, and I'm not saying it's being played, but here's the game. The game is if I move a security out of available for sale into trading or vice versa. So let's say I've got an available for sale security, huge gain. I want that gain on my income statement. All right. So again, I guess you could do it that way, but going the other way to avoid the loss, taking it out of trading, you got to take the hit anyway. So as soon as you say you're going to transfer it, you mark it to market, and the gain and loss goes into net income. Now, moving the last two portfolios, if you go from held to maturity to available for sale, you transfer at fair value, the gain and loss goes into comprehensive income. So if you take it out of held to maturity and you put it into available for sale, it's going to be fair value into OCI. So if you move it out of the held to maturity, and it has to be a debt security, so you take the bond investment or a mortgage, whatever the investment is, take it out of the held to maturity category, move it into available for sale, gain and loss is buried now in the stockholders' equity section. And then finally, the last is where you transfer it out of the available for sale to held to maturity. Once again, you mark it to market, and then there's nothing that's going to happen except that over the life of the security, you have to remember now, if you're going from available for sale into trading, you've got a large dollar amount probably sitting in other comprehensive income, accumulated other on the balance sheet. What do you do with it? You don't transfer it all at once. You would amortize it slowly to net income over the life of the debt. So let's just take an example. You got a debt instrument that's in the available for sale portfolio. You're going to move it to held to maturity. You can only move debt. You can't put anything else but debt into held to maturity. So you got a debt investment. It's available for sale, and it's being moved to held to maturity. So now you've been accumulating other comprehensive income on the income statement for whatever, 8 years, 10 years. That accumulated other comprehensive income is not going to be transferred out of there all at once. It's going to get amortized slowly It's going to get amortized slowly to net income over the life of the bond. So if the bond has another 10 years left, you simply straight line the balance in accumulated other comprehensive income and slowly take that into earnings. Okay. So again, those are the transfer rules. So far what I wanted to do was just establish what goes into each portfolio, what goes on the balance sheet, on the income statement, and the transfers. Any questions on that last case? What I want you to be sure you understand is that if I'm going to be moving an available for sale security, changing its designation, it already has accumulated in stockholders' equity an amount of other comprehensive income. The other comprehensive income related to that security will now be amortized to net income over the remaining life of the debt. And remember, you can only be a debt security if you're moving it out of the available for sale and putting that into the trading or the held to maturity category. All right, any questions on the portfolio transfer? Something you have to obviously sit down and internalize, make sure you understand it. We'll look at some examples, and I'll show you how that would be, at least measuring the securities and the transfers would be pretty easy. Any questions? All right, last, before we go to an example, I just want to tell you that we're not going to do anything on the details here, but just to let you know that if there is a decline that's other than temporary, all bets are off. You're just going to write it down and take the loss. So if you have a security that is impaired, that's other than temporary, and that's the point, and that's where we were talking earlier about during the financial crisis. If you're holding a toxic asset that you think you could recover, and if you could prove that there's recovery, you don't have to take the loss. And that's part of the impairment rules that we still have. So in the event that you can recover the losses on securities, then you don't have to take the loss. Because then the idea is that the decline is temporary. So you have to prove you could avoid the write-down in general. You could avoid the write-down if the loss is considered to be temporary. If it's other than temporary, you have to take the loss. Now, there are steps there. I'm not going to go through all the details, and there are some exceptions. They did start to make some exceptions from the changes that were made in some of the standards after the recession, but in general, if the decline is other than temporary, we used to call it permanent, now it's other than temporary, that write-down is taken. Now, the question is, if you have an other than temporary loss, the question is, what do you do if it's a trading security? What if you do if it's available for sale? The loss has to go through net income. So that if there is a decline that is other than temporary in the security, I don't care whether you call it trading, available for sale, or held to maturity, that loss flows through net income. And that loss is not going to go through an allowance account. That loss is going to hit the investment directly. That's a direct write-off. So if you want to have an analogy with receivables, this is a direct write-off. So if there is a decline that is other than temporary, that loss flows through net income and it reduces the asset directly. It's a direct hit on the asset. You're not going to play around with, allowance accounts or anything else. That becomes the new cost basis. Once you write that down directly into the asset account, that becomes the new cost basis for that asset. Okay. All right. Now, with this background, unless you have any other questions, I want to go through a detailed illustration that will compare available for sale and a trading security. And then there's a multi-security portfolio example that I'd like you to look at. But any questions before we start the illustration? And by the way, other than temporary, on the next page, there are some indicators. I don't want you to go through all this. We just want you to know this in general. But when you think about and you don't have to memorize these steps, but just to give you an idea of what is other than temporary, the first thing you do is you think about whether or not the fair value falls below the original cost, which of course would be clear. Then you have to look at other conditions. There have to be impairment indicators. Is the loss due to a deterioration of earnings? Are there economic conditions in the environment or technology? And then the next question, is it possible to recover the loss during the holding period? If you could recover the loss during the holding period, you typically do not recognize the loss at that point. But if you cannot recover, then you would take the loss. Essentially, that's the third step. So it's just basically a matter of, it's a lot of judgment, but it's a matter of making sure you understand whether that loss has the ability to be recovered. Is it temporary or not?
In terms of recognizing that loss, why would the accountant ever, like let's say you have a stock security that you're holding on to, why would the accountant ever say that, oh yeah, there's this loss is something other than temporary? Like why would they always be able to have some kind of...
No, I mean you have to think about presenting this to someone who knows just as much, if not more than you, about the economy. So if you're holding an asset in an industry that is declining, that you know is going to be years before it recovers. I mean, they've made lots of exceptions with the recession. I mean, I think, and by the way, the so-called softening of these rules was very, very prevalent in Europe, so that the idea of holding it to maturity and recovering was done to avoid these banks from taking any other major hits. If it happens in a good economy, you know if you're holding a bad mortgage, you're going to write that down, right? If the housing market drops, if the price of the house that, you're not going to see this bubble again. If the mortgage is significantly greater than the possible recovery on the home, on a repossession, you would take the loss.
So it's just a fluctuation where housing markets...
Yeah, if it's just they're exactly right. Yeah, I mean, if it's a blip, but remember, during the recession, these rules were used to prevent banks from taking this beating that would be irreparable. I mean, there would be no way the economy would have recovered if the FASB and the government decided to let these hits, permeate the banking industry or, whoever was holding these mortgages. So it would be, as you said, if it's a minor, industry decline, if it's something that you expect, normal cyclical decline, all right, so you hold on to it, not a problem. If it was something as devastating, typically, let's just say not economy-wide, but let's say you had a circumstance where you have a toxic mortgage today, you'd probably be taking the write-down. No, this is all, and a lot of these that you see here are standards that are developed with the IASB. So these are more like IFRS standards with a lot more judgment flowing through. Yeah. Yeah, so you start with the question whether or not your security declined below cost. Is there a recovery period that's reasonable? And if not, if those two are not is the loss below cost, you're not going to recover in a reasonable period, then you take the write-down. Yep. All right, so good questions. All right, so again, it gets interesting. There are some exceptions, but just make sure you have a good idea of this. The main thing is that the loss flows through net income. There's no allowance. There's no recovery here. It's just written down directly. All right, any other questions before we start an illustration? Okay. All right, so we're going to start this on page 5. We're going to start this as an available for sale security, and I'm going to try to, I got to find a way to put this thing in because I want to accumulate some of the information here. So let me just clean this off for a second. If I write on this, you can't see it, correct? You could? Okay. All right, yeah, I'll do that. All right, so let's go through the example. And I'm just going to accumulate the data on the whiteboard, and this will be used first as available for sale. Then I'm going to tell you what happens with trading. Held to maturity is really just the flip side of what we did in Chapter 14, same amortization tables and so on. So it tells you on January 1 of 2012, Sutton Company purchases 200,000 8% bonds at a Mercury Company for $184,557. So they buy them at a discount. So now you're investing. So let's think about what's going on. I will move this over in a second. And these bonds are semi-annual, so that the cash interest or the coupon interest is $8,000. They buy the bonds for $184,557. The bonds will be purchased at a discount. Now, the only thing you have to do with this material is sort of go back to Chapter 14 and just turn it upside down. This is the flip side. So for the corporation, the discount was additional interest expense. The discount for the investor is what? Income. Is interest income. So this is going to be interest income for the investor, and it is semi-annual. The yield, which makes sense that the bonds would sell for a discount, is 10%. So the interest rate or the market rate is 10%. That's the yield. And the bonds mature in 2017, so it's a 5-year bond, right, 2012 to 2017, and N is equal to 10. R is 10, cash interest is 8, and of course this is the face value or the future value of the bond. And of course the issue price or the purchase price is the present value. That's the present value of the debt. Present value is $184,557. Okay, then they tell us that they sell the bonds on January 1st of 2014. I'm going to go back to this, but so they sell them for $185,363. And they classify them as available for sale. So we'll have to tell you typically, sometimes in the CPA exam I've seen where they give you information, they'll say management has an intent to hold these to maturity or something where you have to figure it out, but I will always let you know what the classification is. All right, so now what are the requirements? Well, I want to know what the entry is going to be when you buy the bonds. And if you wanted to, you could probably work this on the HP calculator because you have all the variables here. So if you wanted to, you could prove the PV. So you know the future value, 200. You've got N is 10, I is 10 also, and the payment is $8,000. So if you wanted to put that through, you should get the purchase price. Then we want an amortization table, which we did in Chapter 14. This is a little different than the one we do with leases, because leases are what? Annuities in advance. This is an annuity in arrears, typical debt security. Journal entries for the semi-annual interest. And then here's the key for this problem. You have year ends. This is important for me to illustrate. You have 2 year ends. On the first year end, the fair value is going to be 190,449. Okay, and that's going to be on December 31st of 2012. Then the next year end, 2013, it's 185,363, but then they sell it immediately on January 1st, right after that. So we'll go back to this data with these numbers. All right, so that's the information. So once again, requirement A, the journal entry for the sale. B is the amortization. C, journal entries for the interest. And then D and E are year-end fair value mark-to-market adjustments. That's, by the way, that's probably the, I think, the primary difference in this problem versus what you probably are comfortable with. And then, of course, or have seen before, and then, of course, the sale entry. All right, so first, let's make sure we take a look at A. Here's entry A. You buy the security, just highlighted in blue. And what you're going to do is, this is on page 5, you're going to debit the available for sale security, and you're going to credit cash. And that is for the net amount. Now, I've seen some textbooks do this. We do not use typically a discount or a premium for investments. So just think about a personal investment that you might have. You're not going to set up a separate premium and discount if it's a debt security. So essentially what will happen here is that you're going to have, in this case, you're going to have the investment, and available for sale. I have T accounts later on in the package. And the investment available for sale is net. There's no premium or discount. In this case, there's no separate discount. If you did record the discount separately, it would be a credit balance. It would be a deferred credit. It would be deferred interest income. So don't forget, this is the flip side of the investor. It's deferred interest income. This discount means that you're going to still get $200,000 at maturity, but you only paid $184,557. If that was a zero coupon bond, the discount would be the sum total of your interest. But of course, not only do you get the discount as your return, you're also going to get $8,000 every 6 months, $8,000 semi-annually. So again, any questions? We do not use a separate discount account, but realize that the discount itself, the $15,443, is in fact additional interest income. Questions on the first entry? All right, now for the amortization table, let me just move this on to another page because apparently it doesn't belong here. Okay. All right, so here's your amortization table. And again, it's not any different than the one you've looked at for bonds in Chapter 14, except that now, instead of having interest expense, we have interest revenue. So just to refresh your memory, in the first period, on the date the bonds are issued, obviously there's no interest. On July 1, which is the first interest period, you're going to wind up with cash interest. It's always going to be semi-annual, so it's 4% of the coupon of the, 4% of the face value. So 4% multiplied by the face value, or 8,000. How do we get the interest revenue? The interest revenue is going to be, let me just highlight that for you, the interest revenue of $9,228. That is going to be based off of the semi-annual effective yield against the balance of the debt. So that in this case, the effective interest, 184,557, multiplied by the 5%, oops, gives you the effective interest of 9,228. And that effective interest is going to be your total interest. Your cash interest is 8,000, and the difference is going to be added to the balance of the debt. And of course, if you notice in this column where it has carrying value of the bond, the carrying value of the bond, when it's amortized, it is brought up to maturity. The difference between the total interest revenue of 9,228 and the cash interest is the amortization that gets added to the bond. If this was a zero coupon, what would happen? The balance of the debt would keep going up, and until maturity, when you get to 200,000, you get paid, and at that point is when you collect the discount. You collect the discount only at maturity when the bonds reach 200,000. And notice, of course, that your cash interest is 80,000 at the bottom line total. Your effective interest is 95,443, and the discount represents the non-cash interest, as always. So that if you look at the entry, the first interest entry, debits cash for 8,000 for the amount that we receive. We're going to have a debit to the investment account. So the investment account now increases. The investment account increases, and I do have the T accounts later on in a summary. 1,228. So that represents the accrued but the uncollected interest income. That investment account is like a receivable. Somebody owes you, initially, owes you the opening balance of 184,557. Now, with interest accrued on that, they owe you 185,785. And if we go to the second entry, on December 31st, okay, you don't have cash because you didn't collect it yet, but on December 31st, you're going to debit interest receivable. All right, if it was cash, if it was the date of payment, that same thing. And then the available for sale investment is increased by the amount of the accrued but uncollected interest, which is 1,289. And the balance of the investment goes up to 187,074. So now the investment is on the books at 187,074, and that is the amount that is accrued up to this point with the interest that is uncollected as of the end of 2012. Then, of course, if you continued amortizing the debt, you'd wind up, of course, with the 200,000 in the bond account. You don't use a separate discount account. You could. I've seen some books do it, but we would not. Okay. All right, so any questions on the table? Let me just scroll back up to the amortization table. Any questions on building the amortization table? Again, exam-wise, everyone worries about that. I'm not going to ask you to do a whole table, but once again, think about at least getting a couple of years, a couple of periods done. And you can do this because with the HP, you can easily do this with the amortization routine that's built into the calculator because this is an annuity in arrears, and it works very well. The one I showed you, I could show you how to do that offline if you want, but we did that last semester in Chapter 14. You could build that whole table with the calculator. And then, of course, if you have an assignment on this, which probably we will, you can always build an Excel spreadsheet very quickly. All right, so any questions on the amortization? Any questions on the bond issue? Any questions on the amortization of the discount? Discount amortization for the investor is additional interest income. It's not an expense, it's additional interest income. Okay. All right, now, here's the real issue for us in this chapter. The real issue is the fact that this is now subject to mark-to-market accounting. This is a case of what we would call fair value that's going to be going through net income. The balance of the portfolio on December 31st of 2012 is 187,074. The market value is 190,449. So this means, and I'm going to show you on the table, this means that I have to have a write-up. This is what I need. I need to write up this investment by $3,375. The question is whether or not the allowance account has an existing balance. So here's the issue on a balance sheet approach. The valuation allowance in this case does not have a balance. There's neither a debit nor a credit balance in there. So I don't have a balance right now. The carrying value of this investment, I need to bring this to fair value. I need to bring this to fair value. I will have to write this asset up. I need to debit the asset for the amount of the gain. So in this case, I need to debit the asset for $3,375. I'm going to do that through the valuation allowance. I am not going to debit the asset account directly. I'm not going to debit the asset account directly. And in this case, the cost because this is available for sale, the unrealized gain and loss is going to go into stockholders' equity. This is not income. So the journal entry, and by the way, you can do this either, and I'll show you what this means, cost to cost, fair value to fair value. In the first year, the fair value to fair value doesn't really make any difference. So according to the table, it tells me that if the cost or the carrying value of the portfolio is 187,074, and if the fair value is 190,449, I need a total balance in the allowance account of 3375. I have nothing in there already, so I simply need to make the adjustment that you see in the journal entry. So at the end of the year, I'm going to debit, let me move that to another page so you can see the whole thing. So if you go to page 7, on the top, at December 31st of 2012, I'm going to make the entry that will debit the allowance account for the gain, and I'm going to credit stockholders' equity for AOCI. Now, once again, not a big issue for me if you put accumulated other comprehensive income, AOCI, whatever you'd like to call it. If you want to call this securities valuation allowance, or if you want to call it valuation allowance, it really doesn't bother me. But there is zero way of getting any points if you leave off the fact that that unrealized holding gain is going into stockholders' equity. You don't have to call it AOCI, but you just have to let me know that that goes into stockholders' equity. So this is a critical piece of information. So that in the journal entry, the debit, again, there was no balance to start with, so I didn't have to worry about this. I'm going to show you where you do. I'm going to debit the valuation allowance for $3375, and I'm going to credit the unrealized gain in AOCI, in stockholders' equity. So it does not go into income in this case. It will not go on the income statement. Now, this, to me, is the unique information, something you probably have not seen. Let's get some questions. Yeah.
So if it's a trading security, then you'd have to say it's an unrealized holding gain or loss dash income.
Net income, yeah, right. Okay, good question. If this was trading, you'd have to designate this as unrealized holding gain or loss in net income. In net income. Leaving that off, can't give you any credit. Right? So I have to know. And some people do that. I mean, I don't know. You're going to do it, but someone said, "Oh yeah, I forgot to put the word down, but that's what I meant." You have to put it down. So I have to see where it's going. Okay. Now, the other thing that I wanted you to make sure that you understand is that, obviously, just to remind you, that unrealized gain or loss account in stockholders' equity is a permanent balance sheet account. So that balance is going to carry over year after year. If, in the event, this was going into, and again, I'm going to show you in a moment, but if this was going into earnings, what would happen? It gets closed out to retained earnings. So both on the balance sheet accounts, on both balance sheet accounts, on both the unrealized holding gain or loss and on the valuation allowance, these are accumulating numbers that will not go away. I mean, they're not going to get closed out. They're going to be accumulating. Okay. All right, so in the first year, it's not as big of an issue as the second, which we'll do in a second. But questions before we get to year two. And you also might be surprised when we sell the asset that we've got a little bit of a different, well, probably different than what you would have thought. Okay. All right, so are there any questions on the first year end? Yeah, Brian. Yeah, it's a real good question. I have an example that I'd like you to work on just to get an idea. If it's a multiple security, and I'd rather have you look at a multiple security case. It's much easier for you to see it than for me to try to illustrate it here. We just get a little convoluted. But if this was a multiple security case, this would be the balance. It would be one account for all those securities. And what you would do is you would look at the fair value versus the cost of all those securities and come up with an adjustment on a net basis. And what happens is that you wind up minimizing the gain and loss fluctuation that way. You don't do this by an individual security basis. You do this on a portfolio basis. Okay, so issue I was going to address before I showed you the multi-security, but it's a good question. So when you have a portfolio, that's exactly what it is. It's a diversified portfolio sometimes it's not. You have, thinking about a diversified portfolio, you're going to have some securities with gains, others with losses. The cumulative net balance, it's the net. So this is the net change in the portfolio. So this could have been 15 different securities that you have classified as available for sale. So they wind up netting them out. Now, what gets complicated, which is probably too complicated to show on an initial example, is the fact that if you sell one of the securities, just like an allowance for bad debts, what happens? What happens if you sell a security? At the end of the year, you have to adjust the allowance. And the gain or loss gets sort of, I guess, muddled a little bit because you're catching up with that security. I'll show you that a little bit here. So when you use the whole portfolio, lots of things are netting in and out. And it gets a little bit harder to see. But that's a very good question because everything's done on a portfolio basis. Everything's done on a portfolio basis. And that was done purposely because it minimizes gains and losses. It minimizes volatility by doing it that way. Now, on the balance sheet, it's not as much as an issue as it is for the trading securities. All right, any other questions? All right, so let's take a look at E, which is the next year end. Now, here's where I need to let me clean this up a little bit. Get this out of here. Okay. The fair value at the end of the next year, the fair value at the end of the next year is 185 363 at the end of 2013. At the end of 2013. When I look up on the table, it tells us that the balance, and let me just update the balance for you now, because what happens is that, I'm going to move this up a little bit, or at least change this. Okay, so the balance we had to start the next year was 184, I'm sorry, 187, excuse me, 074. That was the balance that was here. Now, the next year, if we go back to the table, in the next year, we've got the additional amortization of 134, I'm sorry, 1354, and then 1421, so that the security is carried at amortized cost at 189,849. $189,849. That is the amortized cost on the date, and in fact, you could see it up on the screen in yellow right here. So that's why I've highlighted that box at the December 31st, 2014 date. A 2013 date, rather. That would be the balance. Okay. So by amortizing it for 2 more periods, the balance now is 189,849. At this point, at that year end, go back to the table. On December 31st, we're going to have to adjust the portfolio. When we look at the ledger, the accounts tell us that on the balance sheet, without the allowance account, but that the amortized cost is 189,849. So now, if you look at page 7 at the table, 189,849 is the balance of that security, or as Brian mentioned, there would have been a portfolio at amortized cost. And then, of course, you've got the fair value now at 186,363. I'm sorry, 186, that should be. Sorry about that. Fair value is 186,363. Okay. 186,363 at 12/31/13. So the question is, what should the security be at this point? Well, if you're carrying it at cost at 189,849, but the market value is 186,363, you need to have an allowance account with a balance of 3,486. So this is your desired balance. Now, you can do this in one of 2 ways, and it's got to be a credit balance. You have to write the security down. So here's what you need. Hopefully everyone can see this. I'll just move this out just a little bit. What you need to do is you have to have a balance in here. And you can always do it this way if you want. 3486. So I need to write the security down by 3486 because the fair value has to be 186,363. Okay. Now the problem is I need a credit balance of 3486. I've got a debit balance in there of 3375. So the table tells you, and the T account, some people like to just plug T accounts. I'd rather see it on a schedule. I take the loss from that. I subtract, essentially adding to the loss, what I need to do to get the account at 3486. So what I will need here is a loss. I'm going to have to debit the stockholders' equity section for 6861 and credit the allowance account. So notice that it is a balance sheet approach. You cannot simply take the 3486. You have to do two things. You have to eliminate, and the way I look at it, the first thing you have to do is eliminate the existing balance and then add the loss. The total adjustment has to be 6861. And I purposely designed, or at least took this question so you could see that effect. Because if you're just adding to it, it's kind of easy. This way, you've got to take away the original gain and then include the loss. So if you look at the table, the first thing you're doing when you make an adjustment for 6,861, the first thing is here in the blue, you debit or you remove the, let me make this in yellow so we can change it a little bit. So the first thing I'm going to do is come up with a loss of 3375 to reverse out the prior gain. Because this is on a cumulative basis, you have to reverse out the prior gain, and then I take the 3486 as the additional loss. Either way, I mean, either do the current loss and remove the prior gain. Whatever it is, the adjustment has to be 6861. So the journal entry debits the stockholders' equity section for the unrealized gain or loss in AOCI, and you credit the valuation allowance for 6861. And again, this is the key, and I want to make sure we stop and take any questions you have. You have to be sure that you realize that you are adjusting the allowance account. So that, you know, obviously if I just looked at, and I'll show you something else in a second, another way to get this, but to me this is the easiest way to do it. You take a look at what you need. You have to have a credit balance of 3486. I have a debit of 3375. I got kind of a two-step approach. The first thing I have to do is get rid of the debit or remove the gain and then recognize the loss. I remove the gain of 3375 and then I recognize the loss at 3486. So the total loss this year is 6861.
Fair value and balance sheet, 193, where do that?
Okay, I'm going to get to that in a second. All right. That's the way I'm showing you now is I'm working with the original, I'm working with the amortized cost of the investments. If you look at the T account here, I'm looking at the amortized cost of the investment, the 189,849 against the fair value of the asset. Now, if you wanted to, the other way to do this, is there any other questions on what I have here? So I want to show you one other approach. The other way to do this, if you wanted to, is to say, well, what's the fair value on my balance sheet right now? If you take a look at the T accounts, what's the fair value on my balance sheet right now? I've got 189,849, and I'm writing it up by an allowance of 3375. So right now, if I stopped and went to my balance sheet, the fair value on my balance sheet is 193,224. It's not correct, I know that. But if you didn't make the adjustment yet, and I don't know, I mean, this is one way, I do it either way, whatever you're comfortable with. I sometimes like to do it like this because it avoids going back to the balance sheet and playing with the allowance account. It's pretty direct. What I'm saying is that, okay, I've got amortized cost of $189,849. I've got a debit balance in the allowance account of $33.75. So right now, if I look at my ledger, I'm carrying that investment at $193,224. If the market value of that investment is $186,363, then I know I have to write it down by $68.61. So to me, this is what I'm calling the fair value to fair value comparison. I mean, it's not, I don't know if it's any easier for you. I tend to think of it as easier. I mean, some people do it this way. I like this approach better. I see what I've got on my balance sheet, I compare it to what's in the market, and then I just take the adjustment. If you don't want to do it that way, then you simply play with the allowance account and say, all right, what's in the allowance account? What do I need to have? And how do I make it happen with the debit or credit? So either way, you're going to get to the same answer. So I'm saying here that I need, this is not working, I need the loss, let me just highlight that, I need to come up with the loss of 68.61, no matter how you look at it. 68.61. So I'm saying on my balance sheet right now, before I do anything else, I've got amortized cost at $189,849. I've got an allowance account that's writing that up. The balance on my ledger is $193,224, but if I go to the market, quoted market price is $186,363. I have to write it down by $68.61. That, to me, is the fair value comparison. To me, it's quicker, it's cleaner. You don't have to worry about plugging T accounts, but again, whatever your preference may be. So that's why, Eric, to go back to your question, that's why I'm showing you one of two ways. You can either do a cost to fair value basis, and then you have to play with the allowance account, or the way I'm calling this here, I'm calling this a fair value to fair value basis, where I look at what fair value is on my balance sheet versus what the market's telling me I should have in there. Either way, it's going to get you, should get you to, hopefully get you to the same place. So that is a series of mark-to-market, couple of years, 2 years, mark-to-market adjustments, and you're holding this as available for sale. I'll just show you what happens. I got one more thing to do, and I'll show you what happens if this is trading. Now, I don't want to leave this yet. Questions? Any questions on the logic? Obviously, if you haven't looked at this in advance, and given that you had a homework assignment in operations analysis, maybe you didn't. So what you're seeing now, whether it's first time or not, any questions? Yeah.
So for held to maturity, we already did that in the line except for.
By the way, if it's held to maturity, you would do nothing but this. Yeah, if this was held to maturity, it's just going down the amortization table, making all these entries for interest. Yep.
It's available for sale, then we record the fair value investment only in the valuation account and then onto other comprehensive.
That's right.
And for, we'll eventually.
Yeah, we get to trading, but if it is trading, the next step is everything looks the same as it does in available for sale, except that instead of going to stockholders' equity with the gain and loss, it goes to net income. Yeah, Brian? Yeah. I'm going to show you that. Now, all we have to do is change one of those accounts. The account right on the top of the board, which says AOCI, stockholders' equity, becomes net income or earnings. And that's it. Okay. All right. Any other questions? Any other questions on? Yeah, sure.
The reason, part of the reason why we split it up, the investment for available for security, is that meant to kind of, so we know the cost basis, so we know when we sell it,
Yeah,
how much our gain
exactly
is,
right, yeah.
and then the valuation accounts, just so we know the adjustment for up to fair value?
Yeah, two reasons why we have a valuation allowance. Number one, as you said, when you go to sell it, it's based on the cost basis, especially for tax, right? For sure, you need to know the cost basis. The other reason is Brian's comment about the portfolio. That allowance goes against the entire portfolio, just like an allowance for bad debts goes against all of your receivables. So you need to know the historical cost basis of a receivable when you collect it, how much to remove. The same thing's done here. It's the same logic. Yep. Well, that's the issue. If you, just like if you collect a receivable, at the end of the year, what do? You adjust the allowance against the entire receivable portfolio. And here you would adjust the allowance against the entire investment portfolio. So what normally happens when you sell a security is you don't play with the allowance at all. You wait till the end of the year and then adjust it accordingly for whatever's left in the portfolio. Now I'm going to show you a sale where this is the only security in the portfolio. But in reality, and I'm trying to avoid, I'm going to show you the multi-security for your own, you can take a look at it, work it through, just so you have an idea. But I mean, for us, the basic principles will not change, except that at the end of the year, you would have to make adjustments just like you do with a bad debt allowance. Any other questions? Okay. All right. Now, let's get to the sale. And I know Courtney already mentioned what's going to happen, so I will say that again. This actually is F, typo there. It should be part F. Okay? When you sell a security, think about collecting a receivable. When you collect a receivable, do you go to the allowance account and do anything with it? No. Just debit, cash, credit the receivable. When you sell any security out of a portfolio, you do not consider the allowance account. The allowance account is not considered on a sale. The sale is simply based from the balance of the asset at cost minus the selling price. Okay? So, in this case, in our example, the information that's provided tells us that we sell the security on January 1 of the very next year at 185,363. 185,363. That sale does not, in the calculation of the gain or loss, it does not include the allowance account. Selling price minus the amortized cost. You do not consider the allowance, and the difference between the selling price of 185,363 and the amortized cost of 189, not the carrying value, but the amortized cost, becomes the loss of 4486. 4486 is the loss. And it's a realized loss, and that goes on the income statement. I'll make sure everyone is absolutely attentive at this point. This is an available for sale security. The loss goes into net income on the sale. What I don't want to see, which I see quite often on exams, students are going to put this loss into comprehensive income because they think it's available. Listen, you sold it, it's realized, it's no longer unrealized. That loss goes into net income. So this loss is realized, and it's going to go, let me make sure that you see this. Okay, so that's going to go into net income, not going to go into AOCI. All right, that is a realized loss on the sale of those investments. Realized loss. Now, at this point, now again, I don't care whether it's trading or available for sale, same thing. You don't use the allowance account for a sale. All right. Now, before I do anything else, questions on the sale of the asset? Yeah. 185, 185. Now you sell it the very next day. It's not the fair value on December 31st was 186. The very next day it dropped by 1,000. So back in the problem, I think that's right. Yeah, you sell it for 185. Okay, sold for 185. Okay, now let's see. Okay, any other questions? Now, going back to some of the questions, and Brian had questions about a multi-security portfolio. This is what happens all the time. Here it's going to be very, very clear, very clear. You now have the investment is sold, right? It has no balance. At the end of the year, you look at the allowance account just like you would look at bad debt at the end of the year, correct? What would you do at the end of the year? You would assess your bad debt allowance, and then how would you adjust it? You'd base it on collections. What if you collected all your receivables? What would you do? What would you do with the allowance if you collected all your receivables? You'd remove it, right? You don't need an allowance if your receivables are gone. Now, this is an extreme case where we have no securities left, but if you do have a multi-security portfolio and you sell one of 30 securities, at the end of the year, you do the same thing. You're going to have to think about the carrying value of the existing portfolio against the existing allowance. And in this case, you're not going to need that allowance account. And again, here it was, the balance here is balance is 6861. So, I'm sorry, 3486. I'm sorry about that. 3486. Okay. So we've got a balance of 3486 in the valuation allowance. You have nothing left in the portfolio, and the available for sale requires that you have comprehensive income, and in this case, you would simply write off the entire amount, whatever's left. Okay, so you just debit the allowance account and credit the AOCI, because now you don't carry any more securities. But the point is, I mean, this is an extreme case, but the point is that you would have to adjust the allowance account periodically for changes in the portfolio composition as well as changes in fair value. So again, I'm not showing you a multi-security here, but you would have to make that adjustment. And then, of course, and I'll get to questions in a second, but the rest of this, these are all your T accounts. If you want to go through these, you can. Okay, again, not necessary. I put some of them on the board, but I've had those already. All right, so that's the available for sale illustration. Questions before I just tweak this a little bit for trading? So let's just quickly, this will be very easy if it was trading, but you got to be a little careful with certain things. If this was trading, everything's going to look the same. Except that if it's a trading portfolio, these unrealized gains and losses go into net income. So you would have to report these in earnings. So basically, the first 2 years' adjustments would debit the allowance account in the first year, and you know we have obviously we've got the same security. And we've amortized it down, or up, I should say. And the valuation allowance was a write-up in the first year, $33.75. Okay, so in the first year, you would you're amortizing the discount, you debit the valuation allowance, and you credit the gain. And you realize that that's going to be closed out to retained earnings. All right, so you have to close that out. In the second year, same thing's going to happen. You're going to have 1354 amortization and 1421. So the balance down in the account, same numbers, 189, 849. And in that second year, you have a loss. So the loss debits in, sorry. You can have a debit to the loss on the income statement in that second year of 68, 61, and you credit the allowance account. And once again, you have to close that to retained earnings. And then again, of course, the gain or loss on the income statement goes to zero. So the only difference between the trading and the available for sale is that the trading portfolio, everything's the same on the balance sheet, right? So right now, this should be at fair value. Let me get the fair value number. I think it's 186, I believe, right? 363, it should be at that point. Yeah. So the fair value is on the balance sheet at 186, 363. And it's at December 31st of 2013. The amortized cost is 189, 849, and the allowance account is at 3486. Okay. Now, the only difference is that the unrealized gains and losses have already been reported on the income statement. Now, I'm just going to do the sale and we'll break. I want to make sure we get the sale done. Any questions before we go to the sale? The only difference, we've done nothing different in this entire problem except flow the unrealized gain and loss through the income statement. Everything else is the same. Now, what about the sale? Well, here's where we're going to run into a little bit of a problem because sale is going to be the same. I mean, we're selling it based on cost. So, again, you don't refer to the allowance account here at all. It's amortized cost so that you don't refer to the allowance. So it's the selling price of 185,363 compared to the balance at amortized cost at 189,849, and the loss is 4486. The journal entry is exactly the same. Debit cash 185,363. See it up on the screen. You've got a debit to the loss of 4486, and now we credit the trading portfolio. The problem is that you have already recognized a net loss on the income statement of 3486. So here's what I want you to be sure you realize. You have already recognized $3,486 of losses flowing through the income statement. You're now recognizing an additional $4486. So it is a total of $7,972 flowing through the income statement. The problem is that the prior loss has to be adjusted. You can't take the full 4486 as a loss there. So what you need to do, and let me make sure, does anyone not understand that you now, we'll make sure that you understand that you've already hit the income statement with a gain of $33.75 and a loss of $68.61. So far, you have already hit the income statement with a net loss has already been going from the income statement to retained earnings of $34.86. Now you're telling me you want to take another loss of $44.86. You're double counting, right? Because you've already picked up those losses already. Now, there are better ways to do this. Your textbook and most textbooks do it this way, so I'm going to do it the same way. So I think the easiest solution is to make the correction after the sale. And what you're going to need to do, and this will work out, by the way, just like a bad debt. What would you do if you had too much bad debt in your allowance or too much expense flowing through? You make the adjustment at the end of the year. So I'm going to go ahead and do what everyone else does in these textbooks, and that is I'm going to remove the prior loss. What I'm going to do now is I'm going to debit the allowance account. First of all, I don't need the allowance anymore because I've sold off the securities. So now the securities are gone. 189,849 has been sold. There's a zero balance in here. So I'm going to debit the allowance account. And I'll credit the unrealized holding gain in net income, 3486, which zeroes out the prior loss, and only the loss on the sale flows into the income statement. So you can't double count. You've got to get rid of that other 3486. You have to remove that some way because you've already double counted it. Now, there are other ways to do this. I can tell you right now, the way I like to do this is to say, I'd make one journal entry. I'm just going to show you this. I would make one journal entry, and what I would do is essentially work with the fair value. And I would make one entry. Most books make two entries. The one entry I would make, I'll put this on the side, I would debit the cash account for the amount I receive. That would be for 185, 363. I would debit the loss for 1,000, right? That's all I really need is 1,000 more loss. I mean, you could do it this way if you want, and then I would debit the allowance account of 3486, and I would credit the investment. 189,849. Yeah, okay. All right, so that's what I would do. Because it avoids the adjustment. Most textbooks want you to use this adjustment. I would rather avoid the adjustment and just take the net loss off, considering the basis of the asset at fair value. And in that way, now I get rid of the allowance account, I get rid of the investment account. So you debit cash for 185,363, you debit the loss for 1,000, you debit the valuation allowance, get rid of it, and then credit the investment account. And now you had a prior loss of 3486 plus the loss on sale. Now, the problem with this approach, I'm going to tell you how, you know what, I mean, people will argue theoretically, I guess, I don't know, they may have some time on their hands, but this technically is not the loss on the sale, right? I mean, So it's a misclassification. That's why they prefer, most textbook authors prefer that you debit the loss for 4486. It's consistent. Which way is more confusing? Have two different ways to calculate a loss, one for available for sale, one for trading, or calculate the loss the same way and then make the adjustment a little different. I mean, it's up to you. Regardless of how you do it, the total loss that could hit income against the income statement on a trading security has to be 4486. I don't care which way you get it, but you can do it either way. And the net result is on the bottom of, this now is showing up on the wrong page, but on the very bottom of page 9, notice what happens. I mean, you get the same loss, but it's a matter of, if you look at the table up on top, it's a matter of the timing. And you notice that in 2014, the loss for the trading portfolio is 1,000. So if you look at the timing, the only difference is timing. Cash flows don't change, nothing changes. Cash flows do not change. So that in 2012, trading takes a gain of $33.75, no effect on available for sale. In 2013, there was a loss on the trading portfolio of $68.61, no effect on the available for sale. And then finally in 2014, they catch up. The loss for available for sale is $44.86, but the net loss that you see flowing through is $1,000 for the trading. Yep. Classification-wise, yeah, it depends. You're right, absolutely. If this is a financial institution, you're absolutely correct. The cash flows on a trading portfolio would be operating, and for an available for sale would be in investing. Classification would vary, but the totals would be the same. Yeah. OCI. No, I don't know if you're, it doesn't have a difference because we clear it out. We clear it out over here. So on the OCI, we basically don't affect income here. We just make the adjustments to the accounts as needed. So say you could have made the sale entry the same way, I guess, but you don't always remove the allowance account. That's the thing for an OCI investment, because you may need that allowance if the other securities you're holding in the portfolio actually decline in value. So this is kind of unique to the trading. The situation is unique for the trading. So the other comprehensive income is pretty straightforward. There's no real need to make the adjustment here. The only reason why you're making this adjustment right here is because the securities it's a one portfolio security. This entry right here would be the other alternative. Yep. Well, that loss is realized. So you're not trying to avoid it. I'm sorry?
Sorry, that's the BFF. And in trading, we're removing that loss.
Because it was already recognized. Right. Yeah, but in this case, if you go back here, and I want to make sure I understand the question. In trading, you never recognize any gains and losses until it's actually realized on the sale. Here, you've already recognized, gains and losses, so you have to be sure you don't double count them. So trading is different because trading has already been recognizing gains and losses. So OCI doesn't have the need to adjust. What's that? Well, no, but you're not unwinding prior income. you're recognizing the income all at once. Here, you have to unwind some of the prior income. You have to get rid of, for example, you've got to add back 3486 of earnings. So yeah, I mean, it's going to be the same. You're not going to get any different result. It's a matter of timing and the way it's got to be done. With trading is that you just can't go ahead and add another loss to an existing loss that was already recognized. And that's the difference. It's just a matter of timing, and the approach that was used in the textbooks is the one I'm showing you, but that would probably be your, I'm sorry, what? That would probably be the most common approach. Well, obviously, that means it's time for a break. All right, so we'll stop here. We'll come back 15 minutes. We have, according to my calculations, it's, okay, 15 minutes, and we'll be back. You have another half to go. Oh, okay. Because I just said it's a break for someone that's not. Okay. It's probably easier if you want to leave it. Yeah, no, I don't know
That's okay, you don't need it. As long as it's a business course. We don't do business course. We only give you 33 business courses. Those are just examples.
So if I took, if I think it's a bunch of nine, that's okay, but I'm it's probably better to do that. Right, at this point, I already have my first Impairment. So, yeah.
Yeah, we should have it in New York.
I mean, New Jersey.
Then you just define where it's New York, and then you assess it.
I should be fine with all the courses I'm taking now,
Yeah.
correct? Okay.
Yeah, it's just that 36 business credit thing you have to work out with some people.
Thank you. I'm dying. You expect anything else?
I'm sore too, because I've worked out, but yeah, I've worked out all year.
I'm tired. Oh, yeah.
All right.
Yeah, come on. You want to today? Tonight's the night to quit.
The other coach who we work with,
Give me
Rachel
some balls.
Mitch, said that she's not coming to work today.
How does it work?
The other coach she hated. She said she's not coming to work, she didn't tell me, is that I'm walking into my car on Monday night. She's like, I'm not coming. They literally had no, she was going.
Oh, you found your bag after tell them to come up to the city.
You know what I'm considering?
Here's your flag.
This is well, I'm trying to do it.
It's your laptop.
Or just do that next, that's how I'm or we can watch that Monday.
Who else? Thank you. Good idea. You're like, run to that. You go on left.
You are? Sick. Sannella, did you bring those? Really? And then this.
I know, yeah, sure. Yeah, don't. Lecture capture, just screen my voice. Yeah. Okay, then I see that was a whole separate section, so maybe we can have the holiday, I'll see what we want to use, and we'll go over the lecture again.
Good job, good job. We were just saying.
No, I didn't hear you.
No, it's funny.
I knew how to talk to guys.
I knew it. It's funny because we were just saying that we said, oh, we have a data coming up on, not here, our final.
Can you find me a drink?
What? Yeah, really easy. They're productive. Yeah, I know that. This should probably be easiest material for this. Would take twice. Like calculation.
You know what it is, they have to wait until the other guys come down. Because they think that you as a professor will say, there's
All right. right, I'm going to try to get back. Hello? All right, we're going to try to start up again. If you go to page 13, I'm just going to talk a little bit about the disclosures. In between where we stopped in page 13 is this multi-portfolio illustration that you should look at. But I just want to go through some of the disclosures with you, and then we're going to move on to the second module, which is pretty theoretical. It deals with the disclosures that I think a lot of you have seen. I think it's important. So pretty much we're going to be looking at disclosures. What I've done for you here on page 13, this is a research company. This is a national company. I changed the name and the dates and some of the numbers. And one of the things you can notice on their income statement, this is a research and development company. And you notice that a lot of their income is going to be interest income, because if you look at the highlight where it says interest and other income, they have a significant amount of interest income, because what happens in a research company like this is they will get either donations or you'll get companies to give them money up front to do research. The money's going to be sitting there and they invest it and they keep the obviously the interest. So you can see that the interest income is rather significant. Also below this, there is a two-statement approach. This is a separate statement of comprehensive income, and you notice it starts, there was a net loss, and then of course they have their comprehensive income items. Now, on the balance sheet, notice they have investments in a couple of places. They have short-term investments. Now let me just put the numbers up here for you. They have short-term investments. I don't know, if you can't see this, if you can move over, because this is about as good as I can do with the board. Short-term investments. Then they have investments which are, these are basically long-term, $73,416,252. And then in other assets, that's highlighted in green. In the footnote, they tell you that in other assets they have, and these are equity securities. They have equity securities of $3,574,000. I'm going to show you where this is in just a second. All right, so let's get out of the way. So the total value, the total balance sheet value of the securities that they're holding are $325,995,102. If you compare that to the total assets they have, and I'll highlight that in a second, if you compare it to the total assets, let's say in 2013, it is, sorry, just move that, 391,297,215. So their investments are about 83% of their total assets. I mean, they're carrying 325, and if the total assets of the company are 391, 297, 215, that is about 83% of total assets. So for this company, the disclosures are critical. I mean, this is a huge part of their total asset base, and in fact, this is why, if I just go up again to comprehensive income, the unrealized gains and losses on these securities are very important. You know, obviously now, these unrealized gains and losses, if this is an available for sale portfolio, if they do sell these assets, it's going to be a critical part of their gain and loss or income. So again, on their balance sheet, short-term investments, long-term investments, and in other assets in a footnote, which I'll show you in just a moment, they are carrying equity securities valued at $3,574,000. Okay. And the other, which are probably debt securities, which we'll see, are 322. So these are debt securities. $322, $421, $102. Now, when you go into the footnotes on the next page, the footnote talks about their debt securities, and it tells you that debt securities that the company has a positive intent and ability to hold to maturity, which comes right out of the textbook, are classified as held to maturity. All of the debt securities are classified as available for sale. Fair value is determined on quoted market price. In just a minute, we'll go through the fair value model and show you how and why this is done. And then, of course, they treat a part of their short-term investments, 119.4, as available for sale. And short-term investments consist of U.S. Treasury and other government securities, commercial paper, and notes. Short-term investments classified as held to maturity. That means that they have available for sale as short-term, held to maturity as short-term. It means that you have to prove to the auditors that these are being held as working capital. And of course, classified as long-term would be typically the classification for held to maturity and available for sale. Now, when you take a look at the footnotes, they give you, and this is what you'll normally see, you'll see investments carried at cost and carried at fair value. Now, for the held to maturity, let me highlight that for you, the held to maturity and available for sale. And these are debt securities. These are the debt securities. Now, on the balance sheet, the debt securities amount to $322, $421, $102. Where am I getting those values? Just sort of a non-clicker question. Held to maturity, what is the value on the balance sheet? Which one of the numbers up there under the held to maturity columns would be on the balance sheet? Which one? What column would you look at for held to maturity? Amortized cost, and the total amortized cost is going to be here at, sorry, let me make sure I get that straight, at 197. Available for sale, has available for sale carried. Cost or fair value? Fair value, so available for sale will be carried, at 123, or 125 rather. Now, the trouble is you don't get to see, and I guess if you read the rest of the footnote, you'll know what's short-term and what's long-term, but the portfolio, the held to maturity, is at cost 197, 297, 731, and the available for sale in the footnote 125, 123, 371. And that should come to 322. That's the value, that's how the debt is valued on the balance sheet. Now, in the footnotes, you'd have to read this through to see what's short-term, what's long-term, and this is what I mean by a mixed attributes model. We're adding fair values to cost. So when you go to the balance sheet, you're actually adding fair values to cost, and although this is going to change, we really should get, they really want us to have better disclosures, and I'll show you some of those better disclosures in a second, but that right now is what we're looking at. We've got a mixed attributes model where we combine both the historical cost and the fair values. Also in the footnote, they talk about, as I mentioned, talking about the, let me highlight this for you, the equity securities of approximately 3574 is sitting on the balance sheet as well. Okay. So, typical disclosure, there's no trading for this company. As you would expect, companies that don't have a regular operation or regular institution within the organization that trades securities, such as the, I guess the treasury function, would not have any trading securities. Okay. All right. Any questions? Any questions? Okay. All right. Now, at the end of this module, I'm not going to, again, the clickers, I'm kind of skeptical because we have a mixed crowd here. I don't know if they're going to work, but let's just look at a couple of these. The first question is a definition. So that's not an issue. That is a definition of trading securities. So the first one is true. Second one, unrealized holding gains and losses are recognized in net income. All right, so how would you answer that one? False or true. I mean, it's false if what's the case? If it's available for sale, and would that be enough? Well, as you're writing the essay, you say, okay, false. Available for sale securities, where does the unrealized gain and loss get reported? Other comprehensive income. Why? Well, then you have to go through the explanation. Again, it's not part of normal operations. There's a very low probability of short-term cash realization, so there's always a theoretical background. And, of course, you try to avoid volatility in the income statement as well. All right. Number 3. It says a company can classify a debt security as held to maturity if it has a positive intent to hold the security to maturity. Now, again, I wouldn't ask this question because you're missing one word in there. You not only need the intent, but you need the ability. So you'd have to show the accountant the ability, meaning that if based on somebody's analysis of your financial position, that requires that you're going to need to sell these quickly to stay liquid, you can't classify them as held to maturity. So if there's any indication that, based on an analytical review of the company, that the securities will have to be sold in the short run before maturity, it cannot be held to maturity. What's that? It does say ability? Oh, I have the wrong, okay. Then it's true. Thank you. Reading off an old version. Okay. All right. So yeah, it is true. Yeah, it's definitely true. It's definitely true. Yeah, it's true. It's got to be both. It's got to be. The explanation is correct, but the answer would be true. It's got to be positive intent and an ability. Yeah, it's up there. Sorry about that. Okay. So you need both. Let me just correct. So yeah, I correct my own typos and don't even know it. All right. All right. Now, of course, number 4 is true. Companies do not report changes in the fair value of available for sale debt securities as income until it's sold, and that, of course, is absolutely true. All right, because again, if it's available for sale, it goes into the other comprehensive income. And 5 is what? Fair value adjustment account has a normal balance of a credit? No. Has no normal balance. As we said, if there's a debit in that account, it would be an adjunct. If it has a credit, it's a contra. There's no normal balance to the fair value adjustment account. No normal balance, because it could be a debit if you're writing the security up. It could be a credit if you are writing the security down. All right. Any other questions before let me minimize this because I'm not going to use this. Okay. All right. Let me, okay. Go to the next. All right, the next module, by the way, I have this model, this fair value model is on Blackboard. And I should have brought some copies with me, but hopefully we'll be able to see it on the screen. What I want to do in this module, is go over in detail the logic, the theory, and there's no numbers here, so this is going to be up for discussion. Has anyone working in financial services on a internship, did you ever work with the disclosures, level 1, 2, 3? Disclosures, right? Level 1, 2, and 3, that's what we're going to talk about now. These are disclosures that will indicate the reliability of the inputs to the fair value measurement process. So this module is going to help us understand how we measure fair value. We're going to talk about the fair value hierarchy, which is the level 1, 2, and 3. We'll also talk about this fair value option. And again, remember, there's an exposure draft out there that's going to sort of combine all of these standards. It's not going to eliminate a lot of what we do. It's going to change the terminology and not have separate models. It's not going to have a separate fair value option and things like that. All right, so let's take a look at the first. We now have to think about the objectives. There's really no new assets that are going to be measured at fair value under this approach. If you remember from Intermediate 1, we looked at measuring plant and equipment at fair value under IFRS. This is not where we're going here. We're not going to measure any new assets. The idea was to provide a single framework to measure fair value. There's still going to be some differences. So lower of cost or market, the market value used for inventory is not going to be covered here. So you're going to have some exceptions, which we'll show you. But in general, we're trying to come up with a single framework to measure fair value. Before this, it was all over the place, depending on the type of asset. And the disclosures are going to be critical because the disclosures are going to be very important for the user to understand the reliability of the inputs that are used in the fair value measures. Now, in the summary table, which I think you might find interesting, is that when we look at fair value, prior GAAP always looked at fair value as an entry price. How much would you have to pay for the asset to acquire it or to be received if you issued a liability? Now it's completely different. Now we're using, there are some exceptions, but we're now using an exit price concept. How much would you receive if you sold the asset, or how much would you have to pay to retire the liability? Now that makes things very different, because if you bought, just think about this for a second, if you bought a fleet of trucks and you put them on your balance sheet, and if we're not measuring them at fair value, but if we were measuring them at fair value under old GAAP, how much would the trucks be worth on a fair value basis? Well, what would I need to pay to replace them? Now we're saying, how much would you get if you sold them? Different number, right? Because the market value would decline as the vehicles become used. The assumptions, we used to use individual entities. Now we're going to look at a broad market-based, and then again, there are exceptions here as well, but a broad market-based measure. We're going to look at what the market would use to value the asset. We're going to measure fair value with a consistent framework, and here is the most important for me, and what I want you to make sure that you don't get confused, because there are inputs into methods to measure fair value, and there are the methods themselves. When you look at the disclosures, the level 1, 2, and 3 hierarchy, which we'll get to in a few minutes, you're looking at the reliability of the inputs, not the reliability of the measurement itself, and not the reliability of the methods. Now, of course, the inputs will drive all of that, but you're looking at the inputs to the measurement process. Now, when we look at fair value, I'm not going to ask you to memorize the definition, but there are some important pieces here. When you look at the definition of fair value, again, we said it's an exit price that could be attained by disposing the asset or paying off a liability. And here's something that's interesting, and I'm just going to tell you what was used in a, I guess, in the recession period, an orderly transaction. Orderly transaction. So a lot of people were saying that they were exempt from this definition because the markets were no longer orderly. You couldn't sell a house in an orderly market, 5 years ago or 6 years ago. You couldn't trade securities in a normal market setting, so I'm not going to use the fair value. So again, these are just some important, I guess, pieces of this definition. So the pieces are, it's got to be an exchange price. You have to measure it or assume an orderly transaction, meaning that you would not assume a bankruptcy or a deep recession or an unusual market. And then we're going to look at a market participant approach in a principal or most advantageous market. When we look at the market participants, they do say, you have to think about a market where the person is independent from the company, you have knowledge, you have the financial ability, and someone is willing to trade. And I'll show you how that works in a second. The steps, and that's what we're going to get into, in measuring the fair value are listed here. Now let me see if I can get this up on the screen for you. Okay, so let me move this over. Hopefully this fits. Okay, here we go. All right, you have this, actually we have this up on Blackboard, and it's not in the notes. I should have emailed this to you, but the steps are listed in the notes. But when you have a chance, you can print this out. There are 6 steps in measuring fair value. The first step is getting the unit of account. Now, the unit of account is generally pretty simple. It could be, if it's a derivative or a financial instrument, it's 1 share of stock. It could be more complicated when you're dealing with goodwill, because don't forget, in a goodwill impairment, you have to measure the fair value of the reporting unit. How do you know where the goodwill resides? That's the question. So if you buy, for example, well, I think I did this with you in Intermediate 1. If not, just picture a company that buys a retail outlet that has 3 stores and a credit division. They're really buying the company for the quality of its credit division. That's where the goodwill is located. So it is located in that unit, and that's where you would use the fair value. That would be the unit that you would measure. Now, for us, I'm going to keep it simple. The first step is, if I'm valuing a share of stock or a derivative, I'm going to take the unit of account as 1 share of stock. And it's going to look, by the way, when I get done with this, it's going to look like really, really obvious, because I'm going to use something that's easy to measure. Life gets very difficult with this model when some of the target items that we're trying to value are not quite so transparent, such as the goodwill. Okay. Now, the second step is we have to try to determine the markets that we're going to use based on what is known as the highest and best use of the asset. The question here is, where does the company maximize its value? Does it maximize its value by using the asset in combination with others, or by selling it? So, for example, if you had computer hardware and computer software, using them together might maximize the value of the computer division or that particular asset. If you're selling real estate, then the highest and best use may be in exchange, so that the best use of the asset could be either in use, and when we say in use, it means in combination with other assets. So the terminology in use means in combination with other assets. Another example would be if you're trying to value a factory, if you're buying a manufacturing facility. Okay. The asset you're buying is really the entire manufacturing facility. So you have to value the assets together in use, not separately. So you're not selling the building, the land, the equipment separately in the inventory, you're valuing the entire package. So in use would be assets in combination, in exchange would be assets being sold separately. So the highest and best use in my first example for a share of stock would be in exchange. And also you have to think about the markets. What about real estate? I mean, if you read the FASB standards, which you may or may not have to at some point, you'll see they use examples like real estate. I have a piece of land. What's my best use of this? What market should I be in? I'm thinking, okay, real estate, obviously a piece of land has to be in exchange. It can't be in combination, right? But the question is, real estate in commercial markets versus, individual or housing markets could be a little bit different. Commercial versus residential real estate could be a little different. So we have to think about the market. So in this case, so far, and I'm just using a very simple example, I have 1 share of stock, and its highest and best use will be in exchange. Then the next question is, once I know how I need to value the asset, For example, if I was going to value the factory in total, I would have to get appraisals from a real estate specialist that would deal with appraising manufacturing facilities. That would be the market I would look at. And the market you would look at would be a market that is either a principal market, and that's where you would go first. So what you're looking for, and when you look at these markets, you would start with a principal market. Sorry about that. You start with a principal market. And basically the principal market is going to be the market with the most volume, active trading, easy access or unlimited access. If there is no principal market, you would move to a most advantageous market, and what that is, and that's a market where you would maximize your proceeds, net proceeds on the sale. So the example I give you on the bottom of page 3 is to say if I took a security in exchange and I'm going to sell it, I can either sell it on a domestic market or an international market. Okay? If I don't have a principal market, I would look at the most advantageous. If I don't have a principal market, the most advantageous market in my example would happen to be the domestic market. That's where I would maximize my cash flows. Okay? And then finally, although this is probably not going to take place, if the asset has no market at all, you could create a hypothetical market, and that's going to be rare. So you could create a hypothetical market. Now, in my case, if we look at step 3, my share of stock is publicly traded, so the New York Stock Exchange would be the principal market where I would trade that security. And that would be, again, thinking about this from a market participant's view, that's the way I would trade and everyone else in the room would trade this security. Okay, so that's the third step. Any questions so far? I mean, this is pretty theoretical, but you have to make sure you go back, especially, in practice and the CPA exam and all of that. These come up quite a bit. So unit of account is 1 share of stock. Then the highest and best use, we determine how we need, I'm going to give you another example in just a minute, how we need to view the asset. Do we view it in exchange individually, like a piece of land in real estate, or 1 share of stock? Financial asset, financial instruments would be sold in exchange, or do I look at it in combination with other assets? Do I look at it with a package of other assets? Then once I do that, I know how the asset should be exchanged as an exit, or, in other words, when I go to sell it as an exit price. And then the question is, where is the best market? Do I have a principal market? High volume, active trading, that would be the first place I would go. If that doesn't exist, I would then look for the most advantageous market. And if not, I'd have a hypothetical. Yeah.
So in the stock exchange example, there's multiple exchanges. How do you, so it's because you have multiple principals you then determine?
Yeah, I mean, in that case, if you had multiple principal markets, you would drop to where you would get the highest, where you would maximize the value. Yeah. Transactions costs may be an issue. In fact, in my example, I show you that there is a domestic market and an international market, but because the transactions cost in the international market are so high, the net proceeds are better in the domestic market. Now, if there's one thing I have to say is that if you have, let's say, a selling price or a market value, market value of 100 per share, and if there is a fee of like $5, 95 is what you use to compare. So let's say we have 2 markets, A and B. And that doesn't make any sense. Let me make this 30, okay? All right, so if you have two markets, A and B, obviously the most advantageous market would be market A. I'm just going to tell you, though, what goes on the balance sheet? 100. So even though the net is used for this test as to what's most advantageous, the 100 is what goes on the balance sheet if you're using fair value. So the fees are used to determine the most advantageous market, but not to be put on the balance sheet. All right, so at this point, we now know what the limit of account is, how you're going to exchange it, either in combination or individually, either in use or in exchange, how you're going to value it. You now know the market, and you now need to think about the market mechanism or the approach. Now, obviously, it's easy for the New York Stock Exchange, but if you take a look at page 4 in the notes, I'm going to list this on the board. The methods that we use. Now, again, not to confuse this with inputs, but the methods that we use. You have a market approach. You have something known as an income approach. And a replacement cost, or it says cost here, but I'll say cost. It's actually replacement cost. Okay, so you have a market, you have an income, and you have a replacement cost approach. Now, it's kind of hard to really separate these from the inputs that you use in lots of ways, but the key for the FASB is that wherever possible, you need to use observable inputs so that the less estimation you use, the better it's going to be. So you want to get the measure, the valuation technique. You want to do that with the most observable inputs. Now, a market approach would probably be a quoted market price. That's something that you would expect. Now, the problem here is it's not always that straightforward. I mean, you may want to use a quoted market price for an identical asset or a comparable asset. The question is whether or not that quoted market price is based off of a market that has a high volume. I mean, there's a lot of issues that go here, but typically the market approach would be a quoted market price, a market transaction either using an identical or a comparable security, an identical or a comparable security. The income approach, this is a discounted cash flow or a model that you might think about using Black-Scholes, for example. So this would be like a discounted cash flow model where you would take a stream of income or a stream of cash flows and discount it back to get the fair value. Black-Scholes is another example of a income approach. So the Black-Scholes model is an example of an income approach. And then finally, the cost or replacement cost approach. This is really an exception. This is really not an exit price. It's how much you would have to pay to replace the asset. Now, you might think that that's easy. It is for assets that are still traded. It's not very easy if the asset is not currently on the market. And replacement cost was once required by the Securities and Exchange Commission. Years ago, the SEC, and I'm talking, maybe, about 40 years ago, maybe 1974, 1975, the SEC required replacement costs. How do you get replacement costs? If the market is there and the asset's currently traded, you could find it. What would you do if you have a machine that was built, and I'm going to give you an example. One of my clients was in Jersey City. In fact, it was on Grand Avenue, if you know where that is. It kind of faced right down, the World Trade Center was right down the street. You could actually see it. Go, make a turn, go in there, roofing factory. They were making tar paper for roofs. The factory was built, I don't know, early 1900s. The gears were made out of wood. And we had to bring in a specialist to tell us what would it cost us not to replace that asset with a new asset. What would it cost to replace that asset? To get someone to build an asset with wooden gears. Now you can see what a waste of money that was, and that's why we no longer use replacement cost. That went away real quick. It was extremely expensive. First of all, I'm spending my time in a factory with a consultant trying to value an asset that is no longer being produced. So that's what you'd be facing here. If the asset is no longer produced, you would have to come up with a similar asset to replace the asset that is there. Now today you'd probably have much more leeway, but you would have to come up with the replacement cost. Now, you can use one or all of these techniques. Let's take the factory, for example. All right. For valuing a factory, you can use all three. The land and the building, you could probably get a quoted market price from a similar building and land that was recently sold, a market comparable on a precedent transaction. So that if a building in the area recently sold, I could get a real estate quote for the building and for the land. For the equipment, I may have to use a discounted cash flow model for some of the equipment, or I can use a replacement cost approach if the assets are not actively traded. So you may wind up with a combination of all of these valuation methods. Now, the bigger problem, of course, is the reliability of the inputs to those measures. And that's what we'll get to next. But before we go on, so let's take my example. One share of stock, second step, what's the highest and best use? I'm going to sell it in exchange. New York Stock Exchange is my principal market, and I get a quoted market price. So I use a market approach here. Now, as I said, by using a share of stock, this looks way too easy, but just think about some of the things I'm talking about in practice. It takes a lot of time, a lot of effort, and a lot of estimation in many cases to come up with the fair value. And you have to remember, the purpose of this model is not really designed to measure a share of stock. It was designed to have a consistent measure of all types of exotic assets like derivatives and all kinds of, different types of financial instruments, and on top of that, to measure other types of assets. So all assets will be measured in the same way by using this particular model. Okay. Any questions on the fourth step with these approaches? Okay. All right, let's go to the next one. Well, the fifth step is just applying. Now, in my example, step 5 is really easy. I'm just going to take a quoted market price against the number of shares I'm dealing with, right? It's a quoted market price against the number of shares. But in practice, it may be a little bit more difficult. So, for example, if you had, let's take a factory, and you've seen this in Intro to Accounting, I think, where you have an asset, a factory, that's sold for one price, and you have to allocate it. So when an asset is in use, you may have to allocate the price between the two assets, or the fair value between the two assets. In my case, it's just going to be a simple multiplication. So step 5 is really not a big problem unless you're allocating among diverse assets. Finally, in step 6, this is the key. I mean, for me, for financial statement users, for financial analysts, this is the absolute most important piece of this. This is the fair value hierarchy. This is where you would list the level of reliability of the inputs into these models, so that if I had something like a Black-Scholes model, I've got all different levels working through there. The quoted market price for a security, the same security is a level 1. It's the highest. Level 3 is the lowest. Now, in my case, my step 6, it's going to be a level 1. So when you look at this model, again, just it's on Blackboard, you could print this out, but that's the approach that we're using, steps 1 through 6. Now let me get back into this module and show you what these levels look like. I'm not going to, again, you don't have to memorize everything that's in here, but let's look at the levels. In the footnotes to the financial statements, you have to disclose. Let me give you a page, I'm sorry. This is on page 5 of the module, module 2. You have to describe in the footnotes to the financial statements, for every fair value measure that you use on your balance sheet, you have to describe or at least qualify or classify the level of reliability of the inputs. A level 1 is a quoted market price for an identical asset or liability. Pretty simple, it would be my quoted market price on the New York Stock Exchange. Now again, you have to read into this more deeply for different types of assets, but when you go to a level 2, this would be something then different than a quoted market price directly for the security itself. This would be, for example, and I give you some illustrations, A, B, and C, it would be a quoted price for a similar or comparable asset or in an active market. It could be a quoted price for the same asset in markets that are not active if that's all you have. And it could be other inputs based on just derived from other market observed inputs. So for example, if you're looking at real estate in Manhattan or in New Jersey, downtown Jersey City, you may get a price per square foot for the particular building that's observable, and you may want to apply it to a new building that you're putting up. There are other transactions that you might use as a benchmark to value that building. And then of course a level 3, these are the unobservable inputs. This is where you have management coming up with estimates with discounted cash flows or a Black-Scholes model. So that the other example we did in Intermediate 1 was an asset retirement obligation where you have to project the value of that liability, and we're basically using the same model. The same model is being used. We know the unit of account. We're trying to determine the replacement or at least the restoration of the property. We have to think about the projection out for that cost to reclimate the property, and then we use a discounted cash flow. So this, by the way, is an income approach. That's basically an income approach to valuation. Black-Scholes, that's going to fall, where does that fall in, do you think? Yeah, Black-Scholes would be a level 3, I think. Because, well, what do you have in a Black-Scholes model? You've got the estimated volatility, but then again, that could be a market corroborated. So maybe that's kind of like a, it's kind of like a level 2 maybe. You may have, estimated, that could be a level 3. If it's something you can't really observe, the risk-free rate is what? Observed. So that's a level 1. So it's got combinations. So what I'm saying is that you have to value, or at least rank, I should say, in the hierarchy based on the lowest level. The lowest level drives the classification. So even though a Black-Scholes model has the risk-free rate, which is observable, it's management's estimate in the volatility, and that might make it a level 3. It's probably a level 3. It could be a level 2, depending on where you get the volatility from, right? Because if the stock is traded, the market, could be market observed volatility of the stock. But again, it's got lots of estimates in there.
So basically, BNB 3 be rated as the lowest.
Yes.
3 being the lowest.
Yeah.
So Black-Scholes falls on the lowest.
Lowest, yeah. So when you have a given valuation and it falls into different levels, the lowest level drives the entire classification. So if you have levels 1, 2, and 3 in your inputs, it becomes a level 3. If you have levels 1 and 2, it becomes a level 2. So the lowest level of the inputs drives the entire classification. Okay. Now, just to give you an idea of some of the disclosures, if you look at let's go to page 6. Here's a sample. This came from the FASB. as a sample of what we should be reporting on our balance sheet in the footnotes. Essentially, you would have in your fair value measures, you're valuing trading securities at fair value, which we know available for sale, it's at fair value. Derivatives are valued at fair value. And again, you'll pick that up in probably the summer. I don't know if I'll have a chance. I'll try to go back to that if I can. At the end of this module, there's module 4, which we could circle back if we have time. I don't think so, but we might. And then other investments. So if you look at the trading securities, most of those are level 1, but if you go to the balance sheet, you're going to see them at fair value at $138. But in the footnotes to the financial statements, you have to tell the reader how much of this is not based on quoted market prices. What level of risk is embedded in that fair value? When you look at the derivatives, right, so you do have some of them that may be publicly traded, but you do have obviously lots of that value being pushed out into the lower levels. And then other investments, all of that is a level 3. Now, it was my understanding, and I don't know if it's true, if anyone's worked with this, let me know, but it was my understanding that when this standard first came out, nobody used a level 2. So what most accounting firms said is, I'm not going to take any chances. It's either a level 1. If I don't observe it, it's level 3. If I can't observe the input, it's level 3. If it's not a quoted market price, it's a level 3. So almost everyone that I spoke to in practice at the time was handling it that way. That could have been because of the initial issues regarding the uncertainty as to how these disclosures are going to be used. Now, when you have a level 3, if you look at the footnote, and we don't need to go through tons of this detail, but you should understand that you do need to spend a little bit more time on disclosures with a level 3. With a level 3, you'd have to indicate the changes in the level 3 measures, how much of that level 3 fluctuation is impacting earnings. So if you go to page 7 rather, how much of the level 3 is impacting earnings, how much of it is in comprehensive income, and reconciling the beginning and the ending balance. And how much of this how much of these level 3 securities are still being held at the financial reporting date. Okay. All right, and then finally, and by the way, these are for assets that have significant unobservable inputs. These are assets that you report. Obviously, everything in here, let me go back to page 6, everything in here you're reporting on a regular basis. I mean, you measure trading securities available for sale, derivatives on a regular basis at fair value. But if you go to the last part of this illustration, which is on page 8, these are assets that we will only measure at fair value if we write them down. So goodwill, if goodwill is impaired, and these are all losses on impaired assets, which we covered last semester. If you remember, when we were going through, I guess, chapters 12, 13, when we looked at all these impairments, you had goodwill impairment, assets that were impaired that were held for sale, assets that were impaired that were still on your balance sheet. And notice, of course, that you would have really, especially for the goodwill, you're not going to be able to have, there's no market for goodwill. So goodwill would be, totally a level 3, and the write-down of the goodwill was $72 million at that time, or in this example, so that for assets that are not regularly marked to market or measured at fair value, you have to show them in a separate disclosure. All right, so that is the fair value model. So what I would ask you to do is to make sure you look at the steps, understand what's going on in the steps, and in particular, make sure you're clear about what goes into what levels and what the levels are trying to show you. Again, it's the reliability of the input into that process. By the way, goodwill is probably measured, as you know, when we look at goodwill, when we measure the impairment, we actually go through almost a mock acquisition, and we value the unit as if it was going to be sold, or what someone would obviously be willing to pay for it. But the exit price, if you were going to sell that unit, what would its market value be? And then from that we get an implied value of goodwill. And that implied value is the same goodwill that you would get if this was a merger and acquisition taking place today. Okay, last is this last standard, and again, all of this is going to be pulled together at some point if the new exposure draft becomes a standard. And this last piece is ASC 825, and this is the fair value option. The fair value option is pretty interesting because it now tells corporations that they have an option to value a large number of financial assets and liabilities at fair value. When you look at the fair value option, let me just make sure that this is very clear. It's going to be different than, now you've got, and I'm going to use the terminology that we see in the, or at least issued in the exposure draft. So far, what you've looked at with available for sale and trading, you had fair value going into net income, and that was trading. And you're using an allowance account. Available for sale, you had fair value going into other comprehensive income. And that also used an allowance account. Now the standard setters are telling us, well, look, I don't care, and by the way, you could also have held to maturity, and that's at cost. And there are a lot of other assets that I'm going to throw into this pile in a minute, but now they're telling you, well, you know what you can do? If you use the fair value option, all of these can be measured at fair value with the gain and loss, the unrealized gain and loss going into net income. So basically, you're just throwing out held to maturity, you're throwing out available for sale, and you're throwing out trading. If you want to market at your option, you can do so, and then everything goes into net income, but there's no allowance account. At the date of acquisition, right? It's at the date of acquisition or the date of adoption. Date of adopting the standard. So there's no allowance account. And that's because, getting back to, and that's why, when we were going through the discussion about using an allowance or changing the allowance at the end of the year and all that a while back when we were doing the trading, the reason why this is important is because this is done by an instrument basis. So you could acquire a security today, decide to use the fair value option, buy the same security tomorrow, don't use the fair value option. Now, the reason why the fair value option was put into place under U.S. GAAP was to allow companies to offset unfavorable price fluctuations in the market without getting involved with derivatives, without having to hedge. You could actually hedge by using the fair value option, which I'm going to show you in just a second. Okay. All right, so there's no allowance account, and I guess you could use one if you wanted to, but we typically don't. The other important point here is that, that when we, in some cases, when you buy an investment, you sometimes take the transactions cost and add it. So for instance, when you buy, if you were investing in stock and the stock costs you $5 a share plus $1 commission, how much would you put into the account? Some people would put $6. Most people would put $6, right? It costs you $6. Here they're telling you that the transactions cost have to be expensed. So you have to expense all transactions costs. So we're expensing them. We're not going to put them. It's not going to be capitalized as part of the cost of the asset. Now, one of the big differences with IFRS, in order to use a fair value option under IFRS, you must prove that you're doing it to hedge. So it has to be part of your hedging activities. Under US GAAP, it simply says it could be used to hedge stock price volatility. Now, let me show you what this means. Let me give you an example. So this is on the bottom of page 8, going into page 9. Let me give you this example. This assumes, by the way, someone I know mentioned it has to be at adoption, at the date of purchase, or if you adopt the standard. So if you just adopt the fair value option today, you could obviously for the first time, if it was in the adoption period, you could do so. So let's assume you adopt the fair value option now. Let's take an example. It tells you that a company has $1,000 of outstanding debt on its current balance sheet. It also has debt securities. So let's say it issues debt securities. It doesn't really matter if you're initially adopting it. And market rates have increased. So if market rates go up, the value of the debt investment you're holding is going to go down. To offset the loss, if you elect the fair value option for your debt, if market rates go up, the value of your debt goes down. To buy it back, it's cheaper, so it's a gain. Correct? So if you're holding debt and market rates drop, or market rates go up rather, and your debt is cheaper to buy back, you've got a gain. So basically what happens in this hedging idea is that if you had the debt securities in the trading portfolio, there's a loss, and the loss goes into income, and I'm just giving you the number 250. So again, interest rates have increased, lowering the value of your investment. So the journal entry that you would make, you would debit the loss in income, credit the valuation allowance, and for the bonds payable, if you mark to market using the fair value option. So if you elected to value these securities, usually when they're issued, by the way, that should be, because don't forget you got debt securities, so this is date of issue or acquisition. This should be date of issue also. So if you elected the fair value option on the date you issue those bonds or on the date you adopted the standard for the first time, that means that if interest rates go up, the value of your debt liability is going to go down and it's a gain. So you would debit the bonds payable. We typically do not use an allowance account, but sometimes if you do it, it's not the end of the world, but you typically would not here. So I would say, again, most people would not use it. You would debit the bonds directly. You write the bonds down to market, and you credit the gain. So what happens here is you're offsetting, and that's where the hedging's coming in. You're offsetting the loss here, so that's the loss, and you're offsetting that with the gain on the fair value option. So the loss of 250, and that's a perfect hedge, of course, but for purposes of illustration, you completely offset the gain or loss. Now, this is recommended under US GAAP, but it has to be in place to use the fair value option under IFRS. IFRS requires that you're using this option as part of your hedging activities. Okay. All right, now, that's the fair value option. When, or I should say, what securities are eligible? Again, they call it contract by contract, instrument by instrument. I said that already. Let me just point out, I'm not going to ask you to memorize all of these, obviously, but I just wanted you to note that for the most part, any financial asset recognized and any financial liability are eligible. Now, you see it says accounting under the equity method. We're going to get to the equity method probably on Tuesday in more detail. I may say a little bit about it now, but under the equity method, that's really an off-balance sheet, or in a sense, an unconsolidated subsidiary. Remember, Rob, we talked about this a little bit with the equity method, almost like a proportional consolidation. Under the equity method, you have pretty much an unconsolidated sub. Now we're telling you you can get rid of that equity method and use fair value accounting. So fair value accounting is an option that you could use on a security that you would typically hold as a investment in a subsidiary company. But you don't have to consolidate. That's the thing. That's a very big point. You don't have to consolidate an equity investment. We have in our modules, we have Coca-Cola. Coca-Cola has used the equity method for years. What they do is they'll buy up 30, 40%, never get close to 50 of bottling companies. They don't have to consolidate them, but they pretty much control them. And they benefit from their share of the earnings. And we'll get to the equity method. Equity method in Module 3 is one of the more important topics in this chapter because it really helps you a lot with mergers and acquisitions. And by the way, if you don't take advanced accounting, this is pretty much the basis of mergers and acquisitions. Aside from putting things on big Excel spreadsheets, the concepts are the same. All right. On the other side, what is not eligible? This is important. You can't use the fair value option for any investment that you would have to consolidate. So any investment that you would have to consolidate, and you're going to say, oh, wait a minute, that doesn't make any sense. If I'm consolidating, don't I add up all the assets and liabilities together? Yeah, you do, but what if you have to issue separate company statements? Let's say you own 100% of another company. Do you ever issue separate company statements? Company A, Company B. Your Company A, you own 100% of B. Does anyone know if you would ever issue separate company statements? Okay, why? Well, there's always a why. Always a why. You got to explain it to me. I need to know. Okay? All right, okay, that's good. All right. So, right, because if you don't own 100, well, I said 100, but if you don't own 100%, there's a minority interest. So let's say I buy 75% of your company. The other 25% of the shareholders out there still need to see the subsidiary's financials. Okay? The other very, I guess, easy examples are publicly traded debt. If the sub has publicly traded debt, if you have publicly traded debt, what a lot of people don't realize that is if you have two companies, A and B, and B is still a separate legal entity, and there is debt on their books, the assets of Company A legally do not support the debt of Company B. So you've got to show Company B's assets and their debt if you're not legally dissolving the sub. So if there's publicly traded debt, I've got to show you the separate statements of at least Company B. If that's the case, you have to realize that even if you have to consolidate this company, if you have the investment in Company B is on your books separately, you cannot use the fair value option for that company investment because Company B investment because you have to consolidate it. So anything has to be consolidated, variable interest entities as well. Yeah. That's separate company statements. Yeah, if if there's a 10% rule, which basically says that if the total assets of B relative to A are less than 10%, or their income is less than 10%, you don't have to show, in a footnote, you don't have to show separate disclosures. But I'm talking about where Company B has publicly traded securities. They have to show separate statements. They have to file a separate set of statements. Okay. Now, that's one, where if you have to consolidate, not going to happen. Pension plans. So everything we're going to look at, pension assets and liabilities, that's coming up in some future chapters. Those assets are not subject to the fair value options. One of our favorite topics, leases, right? I don't know. Lease assets and liabilities cannot be valued under the fair value options. I mean, demand deposits of banks, I'm not going to worry about that. In F, we talked about the beneficial conversion option. Okay, so the beneficial conversion feature, which is recorded on a convertible debt, we covered that. That would also be something that you would not be permitted. These are not eligible. All of these are not eligible to the fair value option. Okay, so you cannot use the fair value option for any investment. You have to consolidate any pension assets and liabilities. You cannot use it for lease assets and liabilities, and you cannot use it for demand deposits, as well as a beneficial conversion option that's shown separately in stockholders' equity. Okay. All right, now, the balance sheet disclosures, they would like you, if you use the fair value option, they would like you to have these as clear as possible. So, for example, if you go to page 11, let's say you have loans and leases receivable. The FASB recommends, they highly or strongly recommend that you will not necessarily just bury this in a footnote. They would want you in some way, shape, or form to indicate that out of the $890 million or $1,000 of loans and lease receivables that you're reporting on the balance sheet, 550 are going to be at fair value. The other 340 are at cost or some other measure. So that you have to let the reader know regarding the line items, how much of those are at fair value and how much of those are at cost. And that's what we mean, again, by a mixed measurement model or a mixed attributes model. You're adding cost to fair value, but somewhere in the financial statements, you have to indicate whether or not the assets are at fair value or cost. Same thing with equity investments and also liabilities. I mean, liabilities, you could have debt at fair value as well. So again, out of the fair value, out of the total liabilities of 1225, 60 million or 60,000 are at fair value, and the balance, the 1165, is at cost, at amortized cost. So the balance sheet disclosures under the fair value option are hopefully a little bit better. You probably could put this in a footnote, but you have to be very clear. Much better, I think, than what we saw in our previous example for the trading available for sale disclosure, or the held to maturity and available for sale disclosure we saw before. All right, just one last thing, the income statement. We know that everything goes into net income. Unrealized gain and loss goes into net income. And the transactions costs will go into net income as well. Transactions costs go into net income as well. Cash flow statement. Depending on whether or not this is a financial institution, the cash flows from some of these securities could be operating, investing, or financing. Financing if it's on the debt side. Okay. All right. Any questions on the fair value option? I mean, it's really, I think, pretty simple what you would need to know. Just to recap the takeaways. Again, under the fair value option, you will adopt it on a security by instrument basis. It has to be on the date of issue. Forget about adopting now, because I guess almost everybody who's going to adopt it already did. The date of issue or acquisition of a security, date of issue of debt, date of acquisition of an investment. This is a model that would have fair value into net income. That would mean that all of the unrealized gains and losses hit the income statement. Typically, we do not use an allowance account. And all of your, and by the way, again, it's an instrument by instrument basis. So a security that you elect to measure at fair value, maybe for purposes of hedging, can be done so this year. You buy the same security next year, it may not be at the fair value option. And your expenses or your transactions costs will be expensed immediately. From the disclosure standpoint, the key point is that you must try to, although you're showing everything on a mixed attributes level, you need to be sure that you are, in fact, indicating clearly how much of each line item is at fair value and how much of each line item is at cost. Okay. All right, now, the disclosures there are very similar to the ones we saw before at the level 1, 2, and 3. IFRS we're not going to worry about, except the point that I made that in order to use the fair value option under IFRS, you must have a definite hedging purpose. You cannot use the fair value option unless you prove that it's done for hedging purposes. Under US GAAP, it is simply a suggestion or a recommendation. Okay. All right, now, let me, probably not going to grade these because I don't have any, with the classes being mixed, but let's just go through some of these questions now just to be sure. Again, we're not going to cover all the detail on IFRS. Okay, so let's take the first. And I want to see, we'll discuss these if, all right, so now we're going to go back, and this will help me review, and if there's anything we have to cover again, we will. Well, let's take the first one. Standalone fair value measures can be used if, using the fair value model, the highest and best use of this asset is in exchange. Just want to get everybody's opinion, see where we stand on this. It's a good time to find out if your clickers don't work. All right, let's see what we have. Right. Okay. All right, yeah, it's okay. The good thing is no one answered C or D. I don't know who that is, but you know, if you tell me, I'll give you extra points or something. Because maybe you probably know a lot more than me. All right. The answer is A, by the way, because in exchange, you would look at a standalone value. In combination with other assets, that's in use. It's a different definition. Where we have assets in use, meaning that you'd have a factory with plant assets, with building, with land. Those valuations would not be standalone values. They'd be values in combination. Again, you might have two individual assets that, if separated, would be sold for less than the asset being used together. So if you take a specialized piece of computer equipment with specialized software, if you separate those two assets, they would be sold separately or individually at a lower value. The highest and best use would be in exchange. Okay. All right, now here's one we've already looked at, but let's just I want to get a discussion on this one as well. On a Black-Scholes model, how would you classify it in the hierarchy? How would you classify that one in the hierarchy? Now remember, I said for discussion, so we could get a split on this one. Okay. All right, now, it could, I mean, yeah, we probably would wind up with this in a level 3, probably, because, again, you've got okay. Now, on a Black-Scholes model, where does that fall in? So you've got 3 models. You have 3 models to measure. You've got an income, I should say, market, income, and replacements. This will be an income model. And then some of the variables, let's look at the variables itself. The expected dividend yield, you also have the risk-free rate, price volatility. So you might have, for example, an expected dividend yield. If the company's been paying the same dividends for the last 30 years, this could actually be a level 1. Could be observed. Risk-free rate is observed level 1. Price volatility, well, that's where we've got some problems. If you get this from historical market fluctuations, it could be a level 2. If you're projecting it out, it could be a level 3. So it could be either one. It could be either a level 2 or 3. So I'm saying here, this could be level 1 or 2. This is definitely a level 1, right? Because the expected dividend yield, if the company pays the same dividends historically, it could be a level 1. The risk-free rate, of course, could be observed, or will be observed, and the price volatility, that could be observed as well, but based on projections, it could be market-based, but not necessarily a quoted market price. So again, as an income model, this is and make sure you know the difference, this is the model, and this is the input, and I'd probably say here, level. Probably a 1 or a 3, that's level 1. That's probably a 2 or 3. Depending on what you have or what information you have at the time. So the fact that the level that you report is based on the lowest level, that's going to be a 3 in the classification. Okay, so again, it could be 2. Again, not grading these, just to be sure to, have a discussion on that. And I thought I'd use this as a way to really show you how the steps are built in coming up with the levels. Okay. Any questions on that? Because again, I think that disclosure is probably one of the key parts of this standard. Okay. The third one, that's true, of course. I'm going to worry about that. That's just a definition. Leased assets and obligations. Can we carry those at fair value? No, that's one of the exceptions. And number 5, that is true because, as we said, U.S. GAAP recommends or would essentially say that you probably would use risk hedging as a potential reason to adopt the fair value option, but you have obviously other reasons why you can use it. Under IFRS, you have to use it in a hedging scenario. Okay. All right, so are there any other questions? I mean, talked a little bit about the equity method, but are there any other questions regarding the fair value model? Again, I would recommend get the, right off the blackboard. I've got that model. I should have mentioned that to you. I'm sorry if I didn't. Questions? Yeah.
For the cash flow statement, using the fair value option, if there was a loss and it was available for sale, would you minus it from net income like you do with depreciation and then put it?
Okay, so, all right, but we're doing the fair value option or?
Yeah.
Okay.
Fair
Okay. Yeah, if you're using the fair value option, then you don't really have to worry about those categories. So they all kind of now become securities that are marked to market. But nonetheless, yeah, if there was a loss on that, or you said a gain, whatever it was, a gain or loss, it would go into net income.
Yeah, but then for the cash flow statement, would you minus it from net income? So
Yeah, if it's a loss, it's an add back. A gain would be subtracted. Right. Because again, it's a good question about the all of those. This is a good question. All of the let's say it's operating. Okay, so this is a good question, and let me just get to and what we're going to do is probably the last class, I'm going to go through the cash flow statement, and I'm going to go through everything we covered this semester and show you how but this is good, I should have brought this up. All right, the question was, if there is an unrealized loss in net income in the statement of cash flows, of course, in here, this can be either trading or result of the fair value option, right? So it's either trading or a result of the fair value option. And then here, you'd add it back like depreciation because it's a non-cash. Right, so there's no cash flow on that. Because all you would have done is debited the loss and credited the security or the valuation allowance. Because the entry, let's just say it's trading, the entry would have been the entry would have been to debit the loss and to credit the valuation allowance. All right, so any other questions on these securities? Anything else? Okay. Now, what I'll do, I do have a couple of things. So let me make some announcements, and then we'll pick up on, I guess, on Tuesday. So Tuesday again, let me remind you, let me just get rid of this. Just all right, there's three announcements. Number one is that Tuesday, same time, same place with the intermediate. You don't have intermediate on Thursday. You have a double session of operations. The second announcement, if you're out for the holiday on Tuesday, hopefully this technology works. We're going to have the lectures recorded. If you're not here on Tuesday and you need extra help, we'll get together. Let's get one time and date. Don't down, please. We'll get one time and date to meet, and I will go over all the materials with you for as long as you need. So if you're out for the holiday and the tape is not enough, and the video is not enough, please do so. Now, the other announcements, if you want to, there's a golden opportunity. You can actually have your cell phones out. You can
can be playing with your computer, you can watch films of, the Yankee game, whatever you want to do. We're doing an experiment if you want to, it's actually a research study, where we're piloting a protocol. One day, if you want to participate, you sign this. If you don't sign it, you can't use your laptop. I'm not going to know who's going to sign this. All right, so they're here if you're interested. The other and most important thing, hold on. Come on, I'm letting you out early, too. You owe me 15 minutes. The other and most important thing, did everyone got, the email, that email come out to New York State? All right, now, when you go on our website, I mentioned that we have to sometimes tweak the curriculum a little bit for New York State. And let me just explain this very, very quickly. New York State has a very stringent requirement that New Jersey doesn't. They want you to have 33 credits in accounting and 36 business subjects. We always met that requirement because we used to give you 4 credits, 2 credits of calc, 2 credits of stat. If you didn't have it coming in, we now don't do that. You only have 32 business subjects. If you have economics from a prior life, if you have finance from a prior life, information technology, whatever it is, you don't have to worry. If you came from a 100% pure liberal arts background, and these are the only business courses you have, this summer we will register you for an independent study which will be added to your research course. So the research course will just ask you to do more business-related work, and that will then be added to your work. So if you've got business subjects, don't worry. If not, make sure you see me because you need permission to take that independent study. All right, let's go on to the next amendment. Only 15 minutes. Anyone else with